we are in a fairly sweet spot that's been priced decently into the market.
This is an environment where you have to look at the fundamentals.
We think investors should go into a more diversified, multi-sector approach.
This market is driven by fundamentals, and it's not a gimmicky rally.
We're still having the mother of all debates between the bulls and the bears.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading day started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Equity futures on the S&P 500 just turning positive in the last hour, up by 0.33%. Investors buying the overnight weakness. Nvidia erasing aftermarket losses as the best performing stock on the S&P 500 this year runs into just a little bit of turbulence. Nvidia's down by 1.8% after failing to meet some very, very high expectations. The reaction from the sell side on the edge of comical. Morgan Stanley's Joseph Moore, expectations become more challenging as the superlative becomes mundane. TD's Matthew Ramsey, in what seems like a nearly absurd statement in the context of a quarter in which Nvidia printed data center growth of more than 150% year over year. At least the short-term noise is likely to continue.
So I saw Dan Ives. He's coming on the show shortly. I saw him in the green room, and he didn't have on a black suit that looked like yours, that had a skinny tie. And he said he was a little worried for a hot second that he might have to go out and change his sartorial approach. But it was not to be. And he vows that at the end of the day today, it will be green because people will reassess their freak out and realize that perhaps they were just responding to algos.
It's certainly heading in that direction. We were down a lot more than this after trading yesterday, erasing this morning's losses as well. Look what we get in terms of the numbers. Let's work with the forecast first. For the third quarter, the company looking for 32.5 billion. Analysts had predicted on average about 31.9. But the high end of the range was 37.9. So I guess the whisper on the buy side, the people actually in the name, Lisa, they were looking for a much bigger number.
Well, this was the lowest beat that you'd seen in about 6 quarters. So it shows a deceleration. And there's this larger fear. Has NVIDIA and has, frankly, the larger AI theme kind of run out of room to be a moonshot? That is the concern. Yes, you're pricing in growth, but you can't price in the same type of trajectory that you did a year ago. My question is, how much are people looking at the Blackwell delays, looking at gross margins that actually came in about 3% and saying, hold on a second, they're losing pricing power, they're losing this astronomical rise, and you can create a story that way, and then you look at the numbers and it's sort of a reality check because you start realizing, wow, they're really doing really well. So we're just basically coming up with reasons to fade this story just shortly.
We'll spend some time on those manufacturing difficulties. The price action, though, recovers from last night. If you were looking at the price action yesterday evening, this is not what you expected this morning. The S&P 500 up by a third of 1%, Nvidia down by not even 2%. Coming up a little bit later, the fate of today's market, not just in the hands of how impressed you were or not by those numbers from Nvidia, but also in the numbers at 8:30 Eastern time. Jobless claims just around the corner. Every single week, we just seem to be putting just a little bit more weight on this high-frequency data around the labor market.
Yeah, although the high-frequency data is about clear as mud. I think that's what Emily Rowland said yesterday, because basically you've got contradictory signals in everything. On one hand, yes, you have seen jobless claims creep up just a bit. On the other, when you listen to the rhetoric on earnings calls, these are not companies that are about to do mass layoffs. And I think that that's really important. When you look at the actual underlying numbers, yes, you did have that 818,000 revision downward of last year's jobs. At the same time, that just brings us down to pre-pandemic norms. This is the reason why people aren't baking in some sort of hard landing, but they are watching closely in case they're missing something.
The estimate today, 232,000, bang in line with the previous week of 232K. Mike McKee's going to break down that data for you. The broader cross-asset price action shaping up as follows. Equities doing okay. Just about positive. In the bond market, yields a little bit lower by a basis point, 382.35. Over in Europe, a lot of talk about what's happening with the inflation data, particularly out of Germany. German CPI pulling back from the previous month, which could set up a rate cut not just in September, but at the following meeting, Lisa, in October. It's a break of 111 at 110.95.
This actually is one of my biggest questions heading into the end of the week and next week. Is this weaker dollar story durable? It has actually seen the yuan go positive for the year. Over in China, you've seen the euro cross through 112 briefly. How much is that losing preeminence as you start to see rate cuts being baked in elsewhere and, frankly, lower growth outlooks? this really highlighted that. You saw basically those preliminary CPI numbers coming out of Europe just showing why aren't they going to cut just as much of as the Fed, if not even more?
Yeah, a slightly stronger dollar this morning then, 110.94 on euro dollar. Here's your lineup this hour. Coming up, we'll catch up with Brian Levitt of Invesco on what Nvidia's earnings mean for big tech. James Lucier of Capital Alpha Partners ahead of Kamala Harris's first campaign interview. And Terry Wizman of Macquarie on why unemployment could hit 4.5% in next week's jobs report. We begin with our top story, a beat but not a blowout. Nvidia shares inching lower after posting an underwhelming forecast. Brian Levitt of Invesco writing the following: the market seems to be demonstrating some concerns about the margins and the willingness of the large tech companies to continue to spend on chips into 2025 and 26. Brian's with us for more. Brian, good morning to you.
Good morning.
You've said before you're a FOMO guy. Are you still a FOMO guy after those results?
Yeah, I am still a FOMO guy. I mean, those are outstanding results. I think at some point we need to define what blowout means with regards to this. And, I think what's critical is, yes, NVIDIA is such a big percentage of the broad market, and, but investors are viewing this as like the bellwether for all things right now. I mean, I even heard that there were earnings parties yesterday. I wasn't invited to any earnings parties.
I didn't get an invite either.
Yeah, I assume that. No. So, it is a very focused part of the market. They have a hyper-focused client base, so investors are putting a lot into this because of the heavy concentration. In actuality, a bigger story has been some of the broadening out that we've seen in the market in recent weeks that a lot of investors were hoping for since the beginning of the year.
We can spend some time on the increasing participation in just a moment. You've brought up the customer base. What's happening further downstream away from NVIDIA? Meta, Alphabet, all increasing CapEx budgets recently. Do you see any reason at all to be concerned about the prospect of maybe some of those companies pulling back on CapEx budgets in quarters to come?
I mean, if you listen to them right now, it sounds like overinvestment. Right? And this is like an arms race, everybody trying to get ahead, nobody wanting to be left behind. I think, when we try to pick nits a little bit, my kids just came home from camp, so we're looking for lice, right? When you try to pick nits a little bit, yeah, maybe you start to see some of these other businesses developing their own chips, or, maybe the overinvestment gets too far, but there was nothing in that report that suggests that this structural story is impaired.
Just shave their heads, I'm just telling you. That's probably the best way to go.
But, Grandma's brutal, it wouldn't matter.
It probably would. You're actually not wrong. I did find this interesting, though. About 40% of NVIDIA's return really is coming from these four companies. And that really raises this issue of, okay, can they broaden out? I mean, if you want to talk about the broadening out trade, can they broaden out to a wider swath? They talked about potential governments that were going to be buying chips. I mean, do you buy that? Do they need to? Does that matter? Or are you basically saying people are they need to just shave their heads and move on?
No, I think over time they will need to broaden out that base. I mean, right now you have significant overinvestment from the big names, but of course that creates some of their own concentration risk, ironically. So it will need to broaden out, and it likely will, right? I mean, so far we're talking about generative AI for the most part, but this starts to move into many other different facets.
So you are a FOMO kind of guy.
Yeah.
You sound pretty optimistic. You're looking through the nits. You're taking a look at this and saying, realistically, NVIDIA is still going to be a blowout name. And yet you say, tactically, you favor more defensive positioning, even though you don't see any kind of hard landing, even though you don't see any kind of massive turmoil ahead of the election. Why is it time to be defensive?
Yeah, so that's just a tactical call over the next few months, and we've been very optimistic over the long while here. So it's a tactical call, and largely what you're seeing is leading indicators for the U.S. economy slowing or pointing towards some slowdown here, and you have pretty significant expectations for Fed interest rate cuts now. So it almost feels a little bit like the November-December period of last year, where the markets got very excited about a lot of rate cuts, but the Federal Reserve is still somewhat cautious around how many cuts you're going to get. So the economy slows, and the Federal Reserve is still saying, we're not necessarily going to cut 6 times in the next so many months. Typically what you see is more of a quality environment in the slowdown. This has been a little unique in that indicators are pointing to slowdown, but the market's less concerned about that, and the market's focusing on rate cuts right now. And the Fed has to deliver.
Do you think there's a big difference between now and the start of the year? We're pricing in a lot of cuts now, priced in a lot of cuts at the start of the year. What's the big difference now?
Well, the big difference now is that you're seeing jobless claims move up a bit. You're seeing the unemployment rate move up a bit. So it's more likely that the Fed hasn't moved, right? So it is more likely that the Fed carries through with some of it, right? We're going to ease in September and may ease another couple of times this year. The question is whether you normalize the yield curve in the time frame that the market is currently expecting. So I want to be clear. When I say tactically defensive, we're looking at our preferred indicators that suggest this is usually an environment where quality outperforms. But when we come back to the FOMO comment, I'm a big believer that in the aftermath of peak inflation, in the aftermath of peak rates and peak tightening, the markets tend to do well over the subsequent years. So defensive means more of a factor call, or our view that rates were going to come down, which has certainly happened. It doesn't mean that investors want to be out of stocks. Equities, again, tend to do well in the aftermath of tightening over the next few years.
To put these ideas together, there are a lot of people looking for signal in the response to NVIDIA's earnings yesterday about market positioning, about market sentiment, saying, does this highlight how concerned people are that they are overly leveraged to one specific name and one specific theme at a time, where you can't be a moonshot forever? And it highlights the crowdedness and the willingness of people to just ditch as quickly as they can, even unknown news. Is that telling you anything about positioning and the state of this market just structurally?
Well, what it tells you over the next couple of years is that you have a little bit of a less healthy environment for markets where everything was very concentrated. Now, there was nothing in NVIDIA's news to suggest that was incredibly disruptive for NVIDIA or the S&P 500. We're seeing that this morning. What you would like to see over the next couple of years is this proverbial soft landing, the renormalization of the yield curve. If you get that, an equal weight strategy or different flavors within the S&P 500 should pick up participation. You go through these long periods where the market cap wins, and then you need some type of catalyst to change that. Now, candidly, usually that catalyst is a recession and a recovery. What we're hoping for this time is a slowdown, easing, and a recovery.
That's what's weird about this time. You want to play the recovery to the recession we've not had and maybe won't get.
Which is the reason why we haven't gotten it and maybe won't get it. But at the same time, I wonder how nervous people are. How people are getting a little self-conscious that maybe they're a little too all in on this soft landing theme. Even if it happens, that maybe it's overpriced on a risk-reward level.
You needed to go to those earnings parties last night and ask them how they felt after the numbers dropped and the stock moved lower.
I did. Yeah. There was a lot of confusion, and then they pressed sell. And then they took a drink.
I didn't know we were doing that now. Is that what we're doing now?
There were these parties, but it was sort of interesting. There was an article about the parties.
Right.
I forgot what they're called. I have to go back and remember what they are called. Of course, I was there doing crowd research, but I still have to do the research just by doing Google. But to me, there is this question of how quickly they lost their faddom. You know what I mean?
Okay.
It's sort of, the fact that it didn't really carry through.
Shall I do a Chair Powell viewing party next Fed decision?
Why not?
September 18th.
I'll join you.
Host it in a pub downtown or something.
That sounds...
You do the show with TK.
Oh, gee, thanks.
I'll be down a microphone. You know like they do with the sports, so the football.
We're going to do it a remote. That would actually be very appropriate. I think that some people would like it more than others.
Probably prefer it.
I wouldn't really think that was
TK would
you.
love it. Yeah, absolutely. Brian Levitt, thank you, sir.
Thank you.
Brian Levitt there of Invesco. NVIDIA, just to check in on the name. Lisa, we were trading as low as 118 earlier this morning, literally 2 hours ago. Now we're around 123 in the pre-market.
Which I guess isn't surprising when you actually take a look at the numbers, considering that they actually did beat expectations pretty much across the board. Yes, it wasn't a blowout. It didn't meet the top expectations. But the fact that people are looking at margins as a reason to lose hope, the fact that margins came in, when you take a look at what the CFO actually said about margins coming in, 3%, was this was a direct result of the Blackwell disruptions, and that it was going to shift back as soon as those were corrected. So it wasn't basically saying, this is it, guys. It's over.
Still trading lower by 2.2%. Stay tuned. Dan Ives of Wedbush is going to join us shortly. He won't be saying this story's over. He is very bullish. He joins us on the other side of the commercial break in just a moment. Let's give an update on stories elsewhere this morning. Here's your Bloomberg brief. White House National Security Advisor Jake Sullivan wrapping up a 3-day trip to China with a meeting with President Xi Jinping. It's the first time Sullivan has had one-on-one talks with the Chinese leader. The meeting coming hours after his first ever face-to-face with a top Chinese army general. Elsewhere, the FBI saying the gunman who attempted to assassinate Donald Trump searched online for both Trump and Biden campaign events and looked up information about explosives online over a span of 5 years. Investigators have conducted nearly 1,000 interviews, but say the suspect's motive is still unclear. And finally, Salesforce shares rising in the pre-market, the software giant beating second quarter expectations, relieving some investor concerns over a potential sales slump. Salesforce also announcing that CFO Amy Weaver will step down once her successor is chosen. That's the latest then. Up next on the program, Nvidia hitting some turbulence.
The demand for Blackwell far exceeds its supply, of course, in the beginning, because the demand is so great. But we're going to have lots and lots of supply.
That conversation up next, live from New York City this morning. Good morning. Dan Ives just got back from a viewing party. Hasn't slept. He's going to join us in just a second. Equity futures on the S&P 500 recovering, up by 0.25% on the S&P 500. Nvidia doing a little bit better. We're still down by 2.4% in the pre-market. Under surveillance this morning, Nvidia hitting some turbulence.
The demand for Blackwell far exceeds its supply, of course, in the beginning, because the demand is so great. But we're going to have lots and lots of supply, and we will be able to ramp starting in Q4. We have billions of dollars of revenues, and we'll ramp from there into Q1, into Q2, and through next year. We're going to have a great next year as well.
Here's the latest. CEO Jensen Huang telling Bloomberg supplies will be plentiful, even as Nvidia's new Blackwell processor lineup is proving more challenging to manufacture. Dan Ives of Wedbush still bullish. We believe Nvidia's surging AI chip demand, Blackwell delay concerns allayed, robust outlook, and a meteoric enterprise pipeline speaks to this AI revolution just starting to kick off its next phase of growth. Dan drops by the studio for more. Dan, good morning to you.
Great to be here.
Let's start with the production problems. What did he say overnight that allayed your concerns?
There were worries that these delays were actually going to linger into year end. And essentially, they put that to rest. And I think that's something, you talk about billions from Blackwell, but ultimately, we're talking about what could be tens of billions. So if anything was going to spoil this party, it was the Blackwell delays. And I believe, even though the initial reaction, bears came out of hibernation mode for a little last night, it was good to see him, I believe this is a stock that should be green today. And for broader tech, you heard everything you needed to, and from a demand perspective, from Godfather of AI, Jensen.
Manufacturing this stuff is incredibly complex. Apart from saying it will increase, was there any real detail about manufacturing yield improving somewhat through the quarter? Did you get any real detail about what was actually happening at these factories?
He talked about yields improve. And if you look from a yield perspective, the biggest thing that could hurt this story was significant Blackwell delays. And that's something that checked the box. You look at the demand perspective in terms of the October quarter. Okay, could Whisper has been 33 billion, it was 32.5 on the margin. Realistically, as they execute, this is probably going to be a 33, 34 billion type of quarter. So then you look out further and you're like, okay, you start to get these 2 billion and 2 billion continued beats. You start to look at earnings power that significantly goes higher into next year. And relative to CapEx and everything we're seeing in tech, this was the most watched earnings. I mean, we had watch parties. I'm not sure if you were at one of the watch parties. And it's something where I think they came, delivered, and I think for tech, this is going to put fuel in that rally.
Here's a comment from one of those parties. It's fun. It's like a cultural thing. You don't have to be here to root for a winning team. I'm just letting you know, very much the popular zeitgeist. I'm very curious, though, about what you think with the Blackwell revenues that they are projecting out. They were very nonspecific. They said, yeah, billions of dollars. And people are looking at that and saying, if you really want to convince us that this Blackwell delivery delay isn't going to be a serious problem, why not provide specifics, especially at a time where margins are coming in, especially at a time where they're not able to diversify their buyer base.
Yeah, and we think that's ultimately, from all of our checks in Asia, tens of billions, not just billions. But Jensen, grand wizard, grandmaster poker player, not going to reveal the playbook. That's smart. But if you look at NVIDIA here, this is LeBron in high school in terms of where this story is ultimately going. And the most important thing is the multiplier effect. Because this is for broader tech. It's not just about NVIDIA. It's not just about Microsoft. For every dollar spent on an NVIDIA chip, we believe it's an 8 to 10 multiplier across tech. And I think that's something that's probably the most important for investors.
You know, it's fun, and it's fun to talk about The Godfather and popcorn and all that. You actually have been in Asia a lot, and you've been looking at the factories, and you've been talking to people who are the end buyers of some of these chips and the producers to understand exactly how much demand there is. What have you seen that gives you such confidence that this really is a takeoff story, even now, with some questions about how long the magnificent 3 or 4 U.S. big tech companies can continue to support it?
Yeah, and we'll be going back to Asia on next week. $1 trillion of CapEx is what we see from an AI perspective over the next 3 years. You go back 6 months ago, we thought that was $500 billion. And so every quarter, if you look at the underlying demand, not just from hyperscalers, but eventually what's going to be other enterprises, it's just starting. So all of our checks are showing demand's actually continuing to accelerate. You know, as Fargo talked about, yields are improving from a production perspective, that they're the only game in town. Use cases are coming through. We saw that with Palantir. You see that with ServiceNow. Now this fourth industrial revolution, Rome wasn't built in a day, neither will AI revolution. It's starting to come together. Anyone that thinks this is hype, you listen to conference calls, NVIDIA, AMD, Microsoft, Palantir, and others. I mean, I don't know what watch party those bears are, but they're not listening to the calls that I am.
You say it's LeBron at high school. Why isn't it Zion Williamson? Why couldn't we end up with a situation when we actually get real competition and it just doesn't do that well anymore? How big is this moat around this company?
Yeah, and I think it's a great question. Right now, only game in town. AMD and obviously Lisa Su and others are going to benefit. The reason this is a LeBron in high school is because they are so ahead of any other competitor. And right now, they're the only game in town. The new gold, the new oil, it's AMD chips. And when you come away from that conference call last night, now I get after hours and bears will come out, but there's nothing that makes me think that we don't have a year from now or less. You have $3-4 trillion market caps. Godfather of AI and NVIDIA, what's happening in Cupertino with the AI supercycle starting off on iPhone 16, and what's happening with Nadella and Redmond.
Well, okay, in fairness to the bears, because the bears weren't exactly coming out and saying this stock is going to tank. They're saying maybe, just cash in a few chips after 1,000% rallies going back to October of 2022. A real question here of how big the addressable market is, and a question about whether they can essentially go into some of the data centers that their buyer base are trying to fund and create. Basically, how much do they become competitors with their main customers? And a real question about cannibalization at a time where big and bigger companies are increasingly gaining the scrutiny of regulators. How much are you sort of factoring that in as a ceiling for how far this godfather of AI can go?
Yeah, and it's a balance because you even look where like Microsoft's going, where Google on clouds, Amazon. So definitely it's a little bit of a co-opetition that's happening here. Look, from a regulatory is 40 miles an hour in the right lane in a minivan. The technology is 100 miles an hour in a Ferrari in the left lane. And I just think this will be self-regulation. You'll have a lot of M&A. Look at OpenAI in terms of what looks like that next round of funding is. It's a scarcity value. You will start to see those eventually, some more competition. They'll butt heads. But this market, it's the first, second inning of a 9-inning game. That's sort of our view in terms of where we are from an AI revolution.
Monza this weekend, right? Formula One.
Yes.
Big race. Dan, it's good to see you.
Yeah, great to see you.
Thank you. Dan Ives of Wedbush. NVIDIA, Lisa down by 2.5% in the pre-market.
There's nothing wrong with minivans. Just want to point that out. What he's talking about is actually really important, which is essentially how much are we just seeing the beginning? And maybe people have gotten disappointed by the pace of adoption and the pace of some of the use cases. It doesn't mean they're not coming. And that's actually a very interesting distinction that I'd like to explore more.
We'll explore it more later on this morning. Coming up next on the programme, Kamala Harris sitting down for her first campaign interview tonight. James Lucier of Capital Alpha Partners joins us next from New York. You're watching Bloomberg Surveillance. Things are looking a little bit better. Equity futures up by 0.2% on the S&P. On the S&P 500, Nvidia makes up about 6.6% of that index, around 8% of the Nasdaq 100. And Nvidia is doing a little bit better. In the pre-market, Nvidia negative by 2.8%. We'll come back to that story in just a moment, but just a flavour of equities for you this morning. Switch to the board and get to the bond market. Next stop for fixed income, 8:30 Eastern Time, 2 hours from now. Jobless claims drop. The estimate 232,000, back in line with the previous week. And in this case, Lisa, a me is a B. We'll take that 232 and a rate cut in September. Thank you.
Yeah, basically, will we start to see people ratchet back their expectations for a 50 basis point rate cut? Are you even interested in that story anymore? Does it matter? Is it going to be the pace of rate cuts? Have people basically moved on? My question is, can you reconcile the degree of cuts that we're expecting without weakness in a more considerable way? How much have people moved on from the story of a hard landing and just accepted soft landing? And to me, that's one of the biggest sort of clouds over this economy, over this market, I should say, is this is the base case. It is a soft landing. It is soft landing nirvana. How much have people not priced in the risk of recession, even if it's not the likely scenario? Just they're not even counting that in the potential.
And how much of all of this will unlock real dollar weakness? Switch at the board, turn a page and get to foreign exchange. Let's push this through the FX market. I want to talk about the other side of the trade. Lisa mentioned this earlier this morning. Never mind Federal Reserve interest rate cuts. What about the ECB? So take a look at the chart, 110.93. It's a break of 111. We get a regional breakdown of German CPI, ahead of the headline read that you get from the Eurozone tomorrow. And a read down, basically the breakdown of what we got from regional German CPI was weaker than expected almost across the board compared to where we were a month ago, teeing up the potential not just for a rate cut next month, Lisa, but the month after that and maybe onwards from there as well.
And it's not just Germany. The preliminary readout of Spain also shows the same kind of downward surprise when it comes to inflationary pressure. Where is the inflationary concern that's going to outweigh some of the weakness that you're seeing in a material way? When we caught up with ECB officials last week, they seemed like they were increasingly interested in potentially cutting rates just as much as the Federal Reserve. So this idea that the Fed is going to somehow outcut the ECB at a time where the ECB is facing off with more weakness and seeing the same disinflationary pressure, let's see.
That German data will encourage them. 110.93 on the euro. Under surveillance this morning, shares of Nvidia inching lower in the pre-market. The company's highly anticipated earnings failing to live up to some pretty high expectations, delivering an underwhelming forecast and news of production snags on its Blackwell chips. We heard from Dan Ives of Wedbush just moments ago. No real concern there about the supply issues. In fact, for Dan Ives, the fact that we spent the whole interview talking about the supply issues speaks to how bullish he is about everything else, particularly the demand side.
Yeah, given the fact that they definitely continue to outperform, these are some of the snags people are picking up on. About a 3% decline in gross revenue margins, this idea of how much of that's coming from Blackwell. The idea that 40% of NVIDIA's return stems from Alphabet, Google, Meta, and other large data operators. So not diversified in terms of what they're doing. And then just high valuations. Just to put this into perspective, I thought this was an interesting statistic. Their market valuation is more than $3 trillion. That means that NVIDIA is worth roughly the same as the 10 next largest chip companies combined. So it just gives you a sense of how far they have to fall, which is an important perspective before talking about Armageddon.
That's why the bulls aren't freaking out, because the moat's so big. Even if there are supply issues, production snags, manufacturing yield continues to be a little bit lower than expected, no one else is filling the gap anytime soon.
You know what we didn't even mention today? The $50 billion of share buybacks. I mean, it's just the reason why the bulls aren't that worried is because the numbers are pretty astronomical. It's just that they aren't incredibly astronomical, over the top, and everyone's gotten used to this. So at a certain point, how do you price, again, a moonshot? And how do you determine when it becomes just a growth story and not a moonshot, and what that means for future earnings expectations?
The biggest risk for this company, away from supply on the demand side, is the patience of investors in their customers. Do they need to demonstrate a much bigger return on investment on this increasing capex that we're seeing quarter after quarter? And do they need to show it quickly? Don't see that yet in a big way, but starting to see very small signs of it.
You mean we need to understand what AI does?
Precisely.
We need to understand who's going to be able to use it and who's not going to be able to use it. We need to understand the real return on investment. And these are some of the questions that have led to some people to have skepticism. Other people say, just wait. And when you talk, or when you hear some of the executives of some of these big tech companies, as you've pointed out many times, they believe still very much in the story that they cannot invest enough.
NVIDIA down by 2.7%. More on that a little bit later. Let's turn to the Fed speak. Atlanta Fed President Raphael Bostic looking for additional data to support cutting interest rates. Bostic saying the following: I don't want us to be in a situation where we cut and then we have to raise rates again. Raphael Bostic has said this a few times. Now, I'm not saying he's not going to reduce interest rates next month. If you go through some of his recent comments, he's almost there. But the fact of the matter is, we're still having a very different conversation at the Federal Reserve than we are with Chairman Powell himself. For other committee members, I just like, you go back through that speech again on Friday, you listen to comments like that, there's some daylight there. Let's put it that way.
It seems like he talks about his confidence that inflation is truly coming down to the 2% target. It seems like Raphael Bostic might not have the same kind of confidence. That said, we spoke with him last week. This was someone who is very much prepared to cut rates by 25 basis points in September. How much do these declarations push back against the pace and the scope of rate cuts more than the actual kickoff of a rate cutting cycle? They will cut rates. Question is, what's the destination? And is 200 basis points or more of rate cuts by the end of next year overdoing it without some sort of downturn?
You'd have to see some real weakness to get to 50, wouldn't you, in a jobs report?
I think so. Okay. Disclaimer, personal opinion. I don't see how they could justify 50 basis points pushing the market completely off sides without there being a real reason that they are concerned that would justify them recognizing that weakness in a more material way that could spook markets. To me, I don't see the rationale for that.
We've got a week to work out what the number needs to be. Citi's looking for 125 and they say that's enough to go 50 in September. RSM are looking for sub 100 to make that happen. Sub 100? 125? 125 over at Citi. That's a pretty punchy call, by the way. 125 sufficient to engineer a rate cut of 50 basis points on September 18th.
That means they believe that the 50 basis points is all but the base case, and that essentially the bar is very low to get there. They're not really together with other people on that, although if you do think about what Chair Powell said, he did say we would not welcome further cooling. This would be further cooling, so would that prompt a bigger response?
Unemployment, a big factor in all of this as well. We'll bring you some more numbers and estimates through the programme. Elsewhere, Kamala Harris and running mate Tim Walz sitting down for their first interview since accepting the nomination as the pair campaign in Georgia. The latest polling from Fox News showing Harris holding a narrow lead over Donald Trump in Georgia, Nevada and Arizona, while Trump leads in North Carolina. Joining us now, James Lucier of Capital Alpha Partners. James, welcome to the programme. Looking ahead to this sit-down conversation later, what are the questions that you have in mind that you'd like answered later on this evening?
Well, the questions will actually be answered about 1:45 when the Harris campaign says the interview will actually be happening. I think the Harris campaign wants to make as little news as possible to keep that Cinderella moment going as long as possible. Donald Trump would clearly ask pressing questions on fracking on the border, whether she's walked back from any of her positions. But this format of the interview makes it hard to say exactly how well Dana Bash of another network can press these questions. Will she be addressing Harris and Tim Walz at the same time? Why is the first big interview with the presidential candidate a double interview? Is it one long sit down? There's really a lot we don't know about what this interview is going to be.
James, in a big way, I guess our opinion on that matter doesn't really matter that much when it comes to the format. The polls seem to be in their favour. At least that's where the momentum is. James, do you see that momentum continuing?
So the point in this interview would be to do no harm, to provide an interview, to go into that Labor Day weekend, a news cycle on a high note, to demonstrate, yes, that we're willing to step out of the cocoon, we're willing to step out of the bubble and mix it up a little bit. But the fact is, when you're ahead in the polls, there's really no need to play defense. And while Harris is not ahead in the polls by very much, she does have what appears to be a small and sustainable lead, 1 or 2%. She's doing about as well as she and Joe Biden did in 2020, which is probably on a track to win unless Trump can come back and make some of these other issues stick: border, inflation, economy, national security, energy.
James, you said a few weeks ago that choosing Walz for Kamala Harris may have been the beginning of the end of her honeymoon. Have you seen any signs that's the case?
No, as I mentioned, Cinderella, we have a wonderful media honeymoon going on here. It's really a relief rally in financial market terms because where voters or investors, the Democratic base, had written off Joe Biden, they see a very viable candidate here who has a strong prospect of winning, not a guarantee of winning, but very strong position so far. And the real question is whether or not we're seeing a recovery from a Biden deficit or whether we're seeing an expansion. Can she really go beyond 51 or 52? Is she more than recovering the fallen away Democratic voters, the younger women, the African Americans, the Hispanic voters? Is she just recovering those prior voters, or is she reaching out to the midstream and picking up more independents too? That's really the test we need to see.
When you look at all the polls and the aggregators of the polls, they all talk about Harris having a small lead ahead of Donald Trump. And then when you talk to people who focus on the market response to the election, they say that the Trump trade is still alive and that people seem to not believe those polls. They think that there actually is a greater chance that Donald Trump will eke it out. Do you agree, first of all, with that assessment of that sort of divide between polls and markets? And do you think that it's dissonant, or do you think that one is right and one is wrong?
No, I think that Donald Trump is still very much in the game. I think that you have to give Harris an edge for momentum. But at 51, 52% in the head-to-head polls, she still doesn't have what she needs to win. Donald Trump has that electorally efficient coalition, and Trump could win a race with 47 or 48. So in order to be really assured of winning, Harris would need to do better than 2 points. She probably needs about 4 points. So she's not beating the spread yet. That's factor number one. And then while we have horse race polls, we don't have other polls about how voters see the main issues, how voters feel about the candidates, the state of the country. Those sort of polls take much longer to do. And before the Harris nomination, before Joe Biden stepped down on July 21st, you had issues polling showing that voters strongly favored Donald Trump on many of his best issues. Again, immigration, inflation, national security, crime. All of that was Trump territory a month ago. Is it still a Trump territory now? We just don't know. So coming in mid-September, we'll probably start getting some of this more detailed polling about issues, voters' perceptions, how voters feel themselves, and more polling on the state of the country, too. So I think that in about 2 or 3 weeks, probably a week or two after the first debate, we'll have a much better set of data, because you really can't tell a lot from the horse-to-horse, from the head-to-head horse race polls alone.
The momentum has certainly shifted. James Lucier of Capital Alpha Partners, thank you, sir. Looking ahead to that interview later on this afternoon, then, of course, to the next debate, the first debate, for these two at least, September 10th. If you are just joining us, welcome to the programme. Equity futures just about positive by 0.1% on the S&P 500. And Lisa, Nvidia are raising losses. The fear of maybe yesterday afternoon, if we can call it fear, certainly being erased throughout this session so far.
Yeah, to put into perspective, at one point we were down more than 8% yesterday in post-market trading, and now we're down some 2.8%. So can we close that gap? Dan Ives is confident. Otherwise, he will go out and change up his dress.
He almost wore a black suit this morning.
Yes, supposedly. Do you actually think that's the case?
Absolutely not. Absolutely not. I didn't believe that at all. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief. Chinese smartphone giant Huawei posting a 6th straight quarter of growth, the company gaining market share against one of its biggest competitors, Apple. Smartphone shipments jumping 50% in the June quarter, Apple dropping to 6th place in the Chinese market. The pressure on this company, Lisa, going into September 9th. Massive.
You know, I thought this was one of the most interesting stories, just highlighting how much the competition is really pushing American companies out of China. How much is this part of the conversation that we're hearing with Jake Sullivan and Xi Jinping?
It's got to be.
Yeah.
It's got to be. More on this a little bit later. Let's turn to this one in tech. HP shares trading lower in the pre-market. The PC maker cutting its full-year profit outlook on a continued downturn in its printer unit. The disappointing forecast overshadowing the company's first revenue gain in 2 years, suggesting an end to a long slump in demand for personal computers. And your final story, top hopes Novak Djokovic and Coco Gauff easing into the third round of the US Open with comfortable wins. Elsewhere, Americans Francis Tiafoe and Ben Shelton are headed for a third-round rematch. Shelton knocking out Tiafoe in the quarterfinals at last year's event. Did you watch that game last year?
No.
Amazing.
Was it?
Fantastic.
Are you going to go back?
Hoping for more of the same. Nope. Won't be going back.
I'm shocked. This is my shock face.
Bramo, too expensive.
Yeah.
It's too much money.
Yeah, I know. And also late.
Too much money.
Bad hours for us.
It does not work for us at all.
No.
By the time the men's come on in the evening, you're talking like 9:30.
It could have been earlier.
Yeah, you know, I said this evening to James Lucier, and he was like, no, 1:45 in the afternoon. I was like, yeah, that's evening for us.
Yeah, 100% dinner time.
On the edge of night time. Up next on the program, Bostic's big warning.
I don't want us to be in a situation where we cut and then we have to raise rates again. Like, that would be a very bad outcome.
That conversation just around the corner. From New York, you're watching Bloomberg TV. Equity futures on the S&P, positive here by 0.2%, yields just about unchanged. You were looking for a dramatic morning, weren't you? After the fireworks of yesterday, or lack thereof, around Nvidia. That's not what you've got. In the bond market, 383.11. If you want a single name, Nvidia right now, it's down by 2.5%, and Lisa, at one point yesterday in after hours, that was a whole lot worse.
You know, I wonder, and this goes back to something we've been talking about all week. It is the last week of August. Some people would say it's the last week of some. Other people would say, no, it goes until October. But there's this question here of how many people were actually trading last night, just in terms of a lack of liquidity. And now when people come back and they actually take a look at the earnings and they say, really, guys, you're really going to freak out about a beat across the board and projections for ongoing growth.
By definition, it's almost the end of August. We'll agree on that, all right?
Thank
Under
you.
surveillance this morning. Bostic's big warning.
We still have a couple data points to come in. There's still the jobs report that's going to come out, I think, next Friday. These are going to be important markers just to make sure that the trend is still continuing. I don't want us to be in a situation where we cut and then we have to raise rates again. Like, that would be a very bad outcome. If I'm going to err on one side, it's going to be waiting longer just to make sure that we don't have that up and down.
So here's the latest. Investors looking ahead to jobless claims at 8:30 Eastern and the August payrolls report next Friday to solidify bets on a September rate cut. Terry Wizman of Macquarie writing the following. It stands to reason that when we see the August employment report on September 6th, we are likely to see a higher unemployment rate again, perhaps as high as 4.5%. Terry's with us for more. Terry, good morning. 4.5%, sir. Let's start there. What's your read on the labour market that makes you think we're going in that direction?
There's been a deterioration in the labour market in the U.S. It seems to be evident in the data that started to come out in the latter part of the second quarter. It has continued into the third quarter. I would point specifically, and I did point specifically in that report, to what is happening with regard to the polling and surveys in things like the Conference Board's Consumer Sentiment Survey. It specifically showed that the number of respondents that were saying that jobs were harder to get was rising, and the number of respondents that were saying that jobs are easy to get was falling. And it turns out that that is not a bad indicator of the general health of the labor market. It tends to be historically correlated with the unemployment rate over time. That is that spread between hard to get and easy to get. And if you look at where that spread is now, it seems to be much more consistent with an unemployment rate that's in the fives. Now, I'm not saying that the unemployment rate is going to go into the fives, but it certainly is pointing to a deterioration and a direction that would suggest a higher unemployment rate. 4.5%, of course, is just 0.2% above the print from the last month. It's not an egregious or aggressive move to expect. We've seen moves of 0.2% in the unemployment rate.
If we get there, does that tee up 50 basis points September 18th?
I don't necessarily think so. I think that now that we've seen Raphael Bostic talk in dissent, effectively, to Chairman Powell's very dovish speech from a few days ago, I suspect that there are some people on the FOMC that would resist 50 basis points. And to the extent that the FOMC wants to find consensus, they may just go with 25 basis points. But that shouldn't preclude the prospect that in October we could get 50 basis points. It obviously should not preclude the prospect that we are, deteriorating in the labor market, and that's what's eventually going to cause the Fed to accelerate rate cuts if, in fact, it does so.
Someone listening to this might say, I'm going to go out and short the dollar. I think this means that the dollar is going to get a lot weaker because if you've got a weakening labor market and you've got a Fed that's going to cut a lot, that seems like the direction of travel. Oh, wait, and then you look at Europe. Oh, wait, and then you look at some of these other countries. And yet we've kind of had this toggle between the dollar bulls and bears that's becoming increasingly tense. Where do you fall on that?
Well, look, the dollar has clearly weakened in the last 5 weeks against the majors. I'm going to put the Japanese yen aside because I think that's a special situation. But with regard to sterling and with regard to the euro, there's been a clear deterioration in the value of the dollar. I think in part, or I should say in part, everything's in part. Nothing, you can't find one explanation that explains everything. But one of the reasons this has happened is because the Fed has moved in a much more dovish, towards a much more dovish narrative in the last few weeks, culminating with Powell's speech. But the European Central Bank and the BOE have not. They are still in this mode of suggesting that their outlook is cut and hold, cut and hold. In other words, not to cut sequentially. I think, however, that we are looking at a situation in view of the deterioration of growth in the euro area where the ECB can move to a sequential guidance with regard to the outlook for rate cuts, in the sense they could do 25 basis points in each of the 3 meetings this year. The other thing that's happening, of course, is that we're seeing political problems in the UK now, and that seems to be putting in a top for sterling all of a sudden, too. So if you're asking me, is the dollar going to continue to weaken against those majors, I would say no, despite the fact that we are seeing a lot of dovishness from the Fed at this moment.
Just to underscore this point, do you expect the ECB to cut rates more significantly than the Federal Reserve for the totality of 2024?
No, but I think there's a good chance that they do the same amount. If the Fed only does 3 25 basis point cuts between now and the end of the year and the ECB does 3, then you'll have a match effectively. But that shouldn't be the only determination of what happens to the euro or the dollar, right? It's with, the currency is going to move with respect to the surprise in the central bank policy changes, not if what's expected effectively happens. And if there is a surprise, it could be towards a more dovish ECB, potentially a more dovish BOE, especially since we're coming off a time where they have been recently reluctant to signal aggressive rate cuts.
So we'd love your thoughts on a debate that's been emerging over the last month or so. As you know, the investment universe, in the opinion of many, has been building up an aggressively long dollar position over the last few years. We've got this deeply embedded, very entrenched reach for dollar-denominated assets to pick up yield, because you can't get that yield in places like Japan, places like China. And there is a view that once you begin to normalize interest rates, once growth differentials begin to rebalance, higher unemployment rate in America, lower growth, lower rates, that ultimately we unlock a lot of dollar weakness and we get outflows out of those assets. We've had the likes of Stephen Jen, legend of foreign exchange, who you know I'm sure, come out and say that could unlock 10% yuan strength in China. What's your view on that argument and how things stack up?
My view is that it's not about relative interest rates only. Right? Growth plays an important role in the determination of where foreign exchange flows go. And it's not just government bond yields that are important. Of course, returns on real assets and investment in those countries is important as well. And as long as you continue to see better growth overall, real growth overall in the U.S. relative to Europe, let's say, relative to Japan, there will be a strong bid for the dollar. My qualification to that argument, and if I were to support a bearish dollar argument, would have much more to do with the prospect that geopolitical conditions and trends are no longer working in support of the dollar as a reserve currency. If we start to get reserve asset allocators move away from the dollar for geopolitical reasons, then I would have to argue in favor of the weak dollar view. But we're not really seeing that yet, even though some countries are moving away from the dollar, some reserve allocators are moving away from the dollar, some are moving towards the dollar. And right now, we're in a precarious balance between those two.
Is the move in gold the trailer for the movie that we might be seeing in the next year or so?
I'm sorry, which
is the move in gold the trailer for the movie
I think
we might see in the next year?
I think we may very well continue to see a rally in gold. I think that low interest rates, low real interest rates are going to be in support of that going forward, but also geopolitical concerns and risk around global conflict are going to be in support of that trend.
Been around Dan Ives too much, haven't I?
Oh my God, I'm picturing being in a movie theater and all of a sudden,
Dan would write in. Yeah.
Oh, totally. I'm picturing, big gold bullion coming out. It's just wait till the main picture, and then the main picture comes in, dollar weakness.
Next summer.
Could you do that one more time?
Terry Wiseman, thank you. That's not happening again. Terry Wiseman of Macquarie, thank you very much. Coming up, it's not happening again. Coming up next hour, Drew Pettit of Citi, Mandeep Singh of Bloomberg Intelligence, Heidi Crebo-Rediker of the Council on Foreign Relations, and Lydia Boussour of EY from New York. You're watching Bloomberg TV.
Next summer.
On the economic fundamentals, the economy still seems, by and large, pretty healthy.
That combination of the disinflation narrative and better than expected growth is something that's really helping markets continue to run here.
These cuts, I think, are going to grease the wheels for the soft landing.
We do expect some softness in the economy. We don't think it's a recession, but the economy is clearly slowing down.
We are worried that growth can slow, but we're not worried that a recession is necessarily on the horizon.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
2 hours, 30 minutes away from the opening bell, and equity futures doing okay from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now. Equity futures on the S&P 500 firmer by 0.1%. On the Nasdaq 100, we're up by 0.15. And Nvidia's not trading that low. We're down by 3.5%. It was a whole lot worse than this earlier in the session. If you've got supply concerns, Dan Ives of Wedbush says don't worry. If you've got demand concerns, don't see them yet in the numbers or in the forecast. And what you're hearing from the company and the sell side is this company is still a step or two ahead of the competition.
We've been a little too bullish this morning. I'm going to cast some shade on this and explain why people are a little bit concerned. Maybe we've seen the end of moonshot growth. Maybe we have reached the point where they cannot continue to beat and raise to such degrees that people's hats are all blown off. And I think that is the ultimate fear at a time where NVIDIA has not shown the ability to move their buyer base beyond that big data center provider names. And that is a real existential concern. Are they going to broaden out? Are they going to show use cases? Are they going to be able to deliver these types of outsized expectations every single time? That's a little bit of fear you're seeing creep.
These are really, really valid concerns. The fact of the matter is, for the rest of the market right now, if you told me NVIDIA would be down 3 to 4% this morning, I wouldn't have said equity futures on the S&P would be positive by 1%. And based on a price action this morning, that's where we are.
It seems as if people are looking at NVIDIA as its own story that has rallied to such a degree, almost 160% so far this year, taking chips off the table, if you want to use a nice cliche. But there is this issue of it not really representing broader weakness or really the death of a story, just simply maybe questions around how far valuations can get extended in one specific name that has already lifted the entire market for the better part of 2 years.
As Lisa speaks, just a bit more weakness coming into the stock. We're down by almost 4%. You are not welcome at the viewing parties.
I know.
When this reports next quarter.
I was reading the quotes from the viewing parties, and they're treated like sports events. I mean, it was at a bar.
Was this a new thing?
I guess so. I mean, there was one bar in particular in Tribeca.
Not followed this at all.
And, well, there was a really good story about it in the Journal.
Okay.
One person quoted as saying, it's a little disappointing. She's a sports injury analyst. In and of itself, NVIDIA hit a home run today, but they've hit so many home runs in past quarters. I mean, essentially, that's what it's being treated as. It's sort of, can they beat? Can they blow it away? Can he come out? And is he going to be Mookie Betts? But this is the question, right? At a certain point, if they can only look like a regular company and not the rock star in his leather jacket, then suddenly people say, well, maybe they shouldn't have the valuation they do.
The stock is down by 4%. The broader market doing okay, up 0.1%. The next stop for this market, by the way, 90 minutes from now, jobless claims in America. This is the big data point for many of you. The appetizer, if you will, going into the payrolls report on September 6th, ahead of September 18th and that Federal Reserve get together. How low does this number need to be? How weak do payrolls need to be? How high does unemployment need to be to change that 25 basis point cut to 50?
You know, it's a valid question. How much are we going to see actual dissent on this FOMC committee? Maybe not necessarily with 25 or 50, but just even more viscerally discussing why they disagree with Fed Chair Jay Powell. To me, there is an argument, and you have made this, and we have talked about this, and I agree with it, that this level of benchmark rates is just structurally a lot higher than where inflation is at, and you can make an argument for why rates should be substantially lower. But they have not led the market to believe that a 50 basis point is actually the base case. They have that optionality if the market does, if the economy does show signs of deteriorating faster than expected. hard to see how they could really see that bar met unless we see true weakness.
There appears to be some daylight between Chairman Powell and other people on the committee, just based on what we've heard from them all in the last week or so. Elsewhere, outside of equities, in the bond market, we look like this. On a 10-year Treasury at the moment, your yield further down the curve, just about unchanged. 382.92, some weakness for the euro, some strength for the US dollar going against the grain. 110.97 on euro dollar. The read on German regional CPI, a little bit softer than maybe expected, teeing up further rate cuts down the road to the ECB, a weaker euro. That's the story cross-asset, the story for the next hour or so. Coming up, Drew Pettit of Citi as stocks fall following Nvidia earnings. Heidi Crebo-Rediker of the Council on Foreign Relations ahead of tonight's Harris Waltz sit-down interview. And Lydia Boussour of EY on her call for 3 Fed cuts before year-end. We begin with our top story, Nvidia edging lower after failing to live up to sky-high expectations. Drew Pettit of Citi writing the following. High implied growth expectations above long-run estimates create a high bar for results. Essentially, you need a beat and raise that translates into out-year street numbers moving higher as well to justify current prices. Drew joins us for more. Drew, do you think the bar then was just a little bit too high maybe for the Nvidias of this world?
Yeah, I honestly think it's been that way for the better part of this year. Look, before we had our summer squall and the pullback we had, we were talking about taking some profits on the AI high flyers. Now, the market reset expectations a little bit lower, but then bounced right back. So we basically were right back where we started heading into the NVIDIA report. So when we look at the results, yeah, you had an okay beat. They didn't really talk down current year expectations, but the bar's pretty high for the stock. And look, a little bit of a pullback seems healthy right now.
We spoke to Northwestern Mutual earlier this week, making the point, as many people have owned, that if you don't own NVIDIA, you've underperformed the S&P 500, all else being equal, by something like 400 basis points. Drew, is this a theme, a stock that you can afford not to own?
We don't think so. Actually, it's funny. We moved tech from an overweight to a market weight. We think you need to have exposure here. But on some of our focus lists, including our thematic 30 focus list, we actually don't have NVIDIA, and those lists have really kept pace. If you're not going to own NVIDIA, you need some derivative of it. I honestly think, we talked about this before last time I was on, there's a lot of career risk if you don't own this stock.
There's a difference between not owning it, though, and selling a little bit to buy other things. There's sort of an economic bet here that there's going to be some sort of recovery that's going to make less loved names look more attractive. It's not just about NVIDIA and the valuations there. How much of this story for you is that you see economic growth upticks, maybe because of the rate cuts that we're expecting from the Federal Reserve, that offsets the potential gains from the AI story that's been really priced pretty closely in NVIDIA?
I don't know if it necessarily offsets it. I would say it just helps broaden market returns. And look, if we're going to tie this all the way back to fundamentals, we're actually starting to see more stocks in the S&P 500 post positive year-over-year earnings growth now. We're seeing more stocks that are posting plus 10, plus 20% earnings growth. Before, that was just a Mag 7 story. And on the flip side, and this is what helps index math here, is you have fewer stocks that are posting year-over-year earnings declines. So just to kind of spin the answer a little bit different to your question, I don't necessarily say it sucks the wins out of the AI sales. I think it just helps us get more stocks to contribute, which helps hold the index at these higher levels and at higher multiples.
So when you say equal weight for what you're seeing in big tech, where are you putting your overweights?
Right now, we've actually legged into the cyclicals, which is interesting because we're trying to get ahead of Fed rate cuts and a potential upturn in economic activity from lower rates. So everyone, you think you want to wait for the cut to make that positioning move, but markets are going to move ahead of that. So we looked at financials and consumer discretionary as really interesting sectors to start into. Industrials, we moved to market weight just because some of the valuations got a little bit extended there. But that's an area we've actually been pretty long-term bulls on.
Drew, we spent some time on financials over the last few days. Can you just explain something to our audience who've been told repeatedly that for financials to do well, you need a better picture for growth, for loan growth, higher interest rates often helps as well, when most people are predicting quite the opposite, yet at the same time they think financials will do well? What's changed? Why is this different?
It's actually less about rates for large cap financials than it is for kind of mid and small financials. If you get rates down, and that is going to accelerate economic activity, you're looking through a potential short and shallow economic downturn to the other side. And where financials are priced right now, they're basically priced for some slowing in economic activity. So you can buy ahead of that. Back to what I said before, market pricing is going to move ahead of when economic reality happens. And I think that's the story and the bull case for financials right now.
Just in terms of cyclicals, Best Buy coming out with their earnings and seeming to confirm your feeling, raising their earnings per share forecast, and those shares are popping. So if you look at consumer cyclicals and discretionary buying, you do see ongoing strength in some of the reports that we've been seeing, Drew. I'm just wondering, from an overall perspective, though, how hinged is your broadening out call to the prospect of significant rate cuts by the Federal Reserve, given that some people call those into question, given the strength that we're seeing ongoing in the consumer?
Not significantly, actually. There's actually a difference between kind of the Main Street consumer company and the Wall Street consumer company. There's a lot more, let's call them themes at work. Think e-commerce, experiential commerce, and so on, where consumers are still spending money. So yes, rates coming down does help that story. But I think the S&P 500 consumer names are just less cyclical than your broader type of consumer company. I think people need to recognize that when they think about consumer stocks versus the economy. And then the other piece, do we need the Fed to cut a lot to support valuations? Not really, because we've had the 10-year come down, and we've actually seen the 2-year come down and rate volatility come down. All of those things are supportive of higher equity multiples.
Drew, we've got to leave it there. Appreciate the updates, sir, and the clarity from the team at Citi. Drew Pettit there. The latest on their outlook, overweight financials, discretionary. Looking at cyclicals, Lisa, looking for this recovery to a potential downturn in the not too distant future.
I want to actually listen to that again, because some of what he was saying was kind of interesting. The idea that some of the cyclical companies in the S&P 500 are less leveraged to the economic cycle than we may realize. But when you just broaden out, he's not alone. So many people are talking about this.
Heard it tons.
And you've really put it perfectly, which is all these people are preparing for a recovery to recession that is never going to happen. At what point?
Well, I don't know about never.
Well, okay. Well, that has not happened.
Or that they're not expecting.
That they're not expecting. So this is sort of a tension that people have just sort of moved past, and I think is still a very real tension.
Try and stay neutral here, Bramo. Nvidia down by 3.8%. Futures doing okay so far this morning. Let's get you an update on stories elsewhere. Here's your Bloomberg brief. Israeli forces carrying out the largest military operation in the West Bank in years. Palestinian health officials claiming 10 people were killed and several more injured. An Israeli spokesman claiming Iran has smuggled weapons into the West Bank, with this week's operation serving as a preemptive strike. Kamala Harris is on her second day of a 2-day bus tour through Georgia. She's heading through rural areas with a focus on shoring up support among black men. Harris is also getting ready for her first interview since taking the nomination on CNN later tonight. And finally, competition is underway in Barcelona for the world's oldest international sports trophy. Boats from Italy, the US, Great Britain, Switzerland and France are competing for a chance to capture the America's Cup off holders New Zealand. The first America's Cup race took place in 1851. Did not know that.
You ever done a regatta or anything?
No. I'd be terrible at this.
Really? Well, I once did that in a mini fish.
Did you?
Yeah, when I was in junior high school.
Oh, right.
Yeah.
So you can sail?
Yeah, I used to be able to.
Like motorboats?
Yeah. That's on brand. I would just say, this is the kind of regatta where you go around.
The hard work. And no.
Yeah.
No.
Pull in the mainsail.
Nope.
Use the rudder.
Motorboats.
All right, good to know. Good to know.
Up next, NVIDIA's AI reality check.
Hyperscalers represent about 45% of our total data center business. We're relatively diversified today.
That conversation up next from New York City this morning. Good morning. Stocks are positive here by 0.2% on the S&P 500, waiting for jobless claims 1 hour and about 14 minutes away. The bond market not doing much. Your yield 383.30. Under surveillance this morning, Nvidia's AI reality check.
Hyperscalers represent about 45% of our total data center business. We're relatively diversified today. We have hyperscalers, we have internet service providers, we have sovereign AIs, we have industries, enterprises, so it's fairly diversified.
Here's the latest. Nvidia's underwhelming forecast hitting tech stocks, threatening to cool the AI trade that's boosted companies like Meta and Alphabet, which rely on the chip maker for scaling AI operations. At the same time, concerns growing about anxiety and exactly how much these companies are dependent on Nvidia for AI expansion. Bloomberg's Mandeep Singh joins us for more. Mandeep, good morning to you. Concern you've had for a while, supply. And I think for the CEO, you don't just get to say supply is going to improve without really explaining why you think supply is going to improve. Did you get an explanation yesterday?
I mean, he was alluding to the fact that TSMC is able to ramp up their supply at their end, but I think the expanding supply will not just help NVIDIA, but others who are trying to make similar chips, whether it's on the training side or inferencing side. And to me, you know, if supply is expanding, lead times are coming down, that's never good for your pricing. And it was evident in the gross margin guide that they gave. So Q1, it was like upper 70%. This quarter, it was like mid 70%. And going forward, also, the commentary was gross margins are probably going to stabilize around here. 2025, who knows? But clearly, the gross margin side seems to have peaked.
Can we spend some time on the execution issues around Blackwell? Just what exactly is the manufacturing yield? How low is it compared to where you'd expect it to be? How complex is manufacturing something like this?
Yeah, so look, I mean, TSMC is the one who is doing the manufacturing. NVIDIA is coming up with the design. And what typically happens is with any new architecture, yields are extremely low at the beginning because they are packing more transistors. You know, it's doing more in terms of the memory that it's using. And look, it's not surprising to hear that yields were low initially and they're trying to solve the problems. And he seemed to be very upbeat about Q4 Blackwell contribution. So all that is great. I think on the demand side, the product side, the commentary was great. This is, to me, the real standout was the gross margin commentary, the fact that they expect it to really, this could be the peak, and they expect it to come down, albeit gradually. So net, you know, hyperscalers commentary was good. Sovereign, they called out Sovereign being low double-digit contributor. The question that I have is it sustainable the same way as the hyperscaler CapEx is? We know hyperscaler said they will continue to ramp up the CapEx through 2025. I mean, we know governments don't keep just spending CapEx like this, the way hyperscalers' balance sheets are. So I think when you look at their customer base and you look at the growth expectations, the catalyst for further upside revisions are fewer than they were last quarter. And that's where I think you see a negative reaction. There is no growth cliff anytime soon. This is more about, is it going to keep surprising to the upside? And I would say the incremental data center revenue was again $4 billion. There's no seasonality in the business. So the $4 billion revenue, despite all the positive data points that we got, you know, from hyperscalers, sovereign, China, even China business was up sequentially. Still, the beat wasn't that big. So that's where I think the market is looking at and saying maybe there is some digestion that will likely happen in the second half in 2025.
Mandeep, can you elaborate on this idea of margins peaking? Is this basically just running out of pricing power, or is this just simply getting pushback, having to broaden some demand? I mean, what exactly is this?
Yeah, so think of it this way. Anytime they launch a new architecture, it tends to get a higher price because the chip is more advanced, it can do more, and customers are willing to pay a higher price if there is no competition. So in this case, Blackwell should command a higher price, and that should add to the gross margin the same way the Hopper did when they went from the previous architecture Ampere. Now, what sounded on the call, again, the CFO wasn't very clear, is 4Q gross margins will be around mid 70%. They didn't guide to 2025, but clearly they're spending more on the component side, the memory that goes into chips, so that benefits Micron. They're spending more on the foundry side. TSMC is raising their prices to NVIDIA. So all the supply chain costs for NVIDIA are increasing, and that will impact the gross margins that NVIDIA can command. They're a fabless company. They don't make their own chips.
Okay, pause. This is actually fascinating. Are you saying essentially that NVIDIA's suppliers are saying, hey, we need to get in on this game. We're going to raise prices on you guys. And that NVIDIA cannot turn around anymore and say to the likes of Microsoft or Google, okay, you just have to pay us more?
I think so. And again, this is happening very gradually. So it's not as if, the gross margins will compress 500 basis points in a quarter. That will happen when we are at the end of the cycle. There's nothing in the demand commentary that suggests we are anywhere close to that cliff. But clearly, semi companies are, profitable during the cycle when things are going very well. And as the cycle ends, their gross margins shrink. So in this case, because NVIDIA doesn't make their own chips, they can't control how much supply chain charges. And the supply chain is raising prices. Micron is raising prices. TSMC is raising prices.
All this being said, they still were great results. And yesterday, you said you really enjoyed the interview that Jensen Huang did with Ed Ludlow of Bloomberg. You could feel his frustration. We did everything. Why aren't you embracing us? Do you think that the market response was appropriate?
Well, so market is driven by whether we'll see more positive revisions to EPS. Is the 2025 EPS number low? And will we see positive consensus revisions? If not, the stock will go down because the stock is driven by, how much the estimates will go. Are they growing into their valuation? And the answer is the top line commentary was great, but because of the margins, the EPS revisions will not be of the same magnitude. And that's where I think investors will take a pause and see, okay, do we have visibility to 2026 and beyond? Because that's what will drive the stock from here on.
The big test now is the use case. Apple, September 9th. What are you expecting for them to unveil?
I mean, Apple is the one hyperscaler. I put them in the hyperscaler bucket because of their size. That hasn't ramped up CapEx. Every other company is spending more on NVIDIA, ramping up CapEx to deploy their large language models. Apple hasn't because they have the distribution, and that's what they'll focus on is how can they use the smartphone, the distribution they have to deploy these large language models and still participate in this Gen AI wave. And I think they will show that. It's just not having a model is still something that, is a constraint when it comes to the competition.
What can they announce to get us to upgrade? What can they announce?
Well, so remember, Apple designs their own chips, and they can do inferencing for large language models. And that's what Apple Intelligence, the platform they announced, is all about. That you can, even though they don't have their own large language model, you can use OpenAI. You can use other large language models on their phone, and it can offer you the functionality that everyone is raving about when it comes to generative AI, whether it's Copilot or, chatbots and some sort of assistance. So you'll still be able to use it. It's just, it's not an Apple model that you're using.
Let's see what we get. Mandeep Singh of Bloomberg Intelligence breaking down the story with NVIDIA and looking ahead to September 9th and that big unveiling of the new iPhone.
I love this. What can they announce to make us upgrade? That was quite the us. It was doing a lot of heavy lifting there, John.
Other people interested as well. Show's not just about me, Bramo.
Well, is it though? No, I'm kidding. But to be really honest, do you want to upgrade?
I'd be close to upgrading. It's been a few years.
What functionality would you actually be interested in?
Better battery.
That's it, right?
Yeah, sort of baseline.
It's not about something that's going to wake you up and be like, hello, John.
No, I don't need something to manage my day. That would freak me out.
Have you?
You seen those kind of commercials at the moment that the future's not scary? I think the future's scary.
That doesn't surprise me.
Don't you think the future's scary?
I am optimistic.
Are you really?
I think that actually there
You're
could be
optimistic
some really...
about nothing.
Okay. Look, the one thing that scares me is if AI can process information, extrapolate answers faster than humans can.
Yeah.
At what point that becomes a sort of ability to affect change in ways that are out of our control.
In a good way?
In a way that's out of our control. I mean, what's to say that humans are better decision makers than algorithms? Maybe we're not.
Don't know outsource to algos.
I mean, I don't know if they're good algos.
Okay, you go first. Nasdaq futures right now, up a tenth. Coming up, Heidi Crebo-Rediker of the Council on Foreign Relations ahead of tonight's CNN interview with Vice President Harris. A preview up next. Just a flavour of the scores for you. Equity futures positive by 0.2% on the S&P, up by 0.1 on the Nasdaq 100. We're doing okay. 2 hours out from the opening bell, 1 hour away from jobless claims in America. Nvidia, just to check in on the stock just briefly, and then we'll come back to it. We're down about 4% in pre-market trading. In the bond market, 2-year, 10-year, 30-year, your 2-year, the front end of the curve looks like this, 385.88, yield just about unchanged. We work our way further out along the yield curve. We've gone from 2s to 5s. Is it 7s today?
Yeah.
Is that right?
$44 billion of 7-year notes. Yesterday's 5-year auction was interesting because it was pretty strong in terms of some of the dynamics, and yet it tailed, which meant that the yields came in at higher than where they were when it first initially priced. To me, this is interesting because, again, it goes to the dynamic we were talking about. On the front end, very strong, very clear demand, very clear faith that the Federal Reserve is going to cut rates. Longer end, more uncertainty, particularly when it comes to fiscal trajectory and what exactly is going to affect the buyer base.
You've been saying this all week, that the test gets harder, the bar gets higher as you work your way out along the curve. So we've gone from 2s to 5s and 7s later. We had a series of guests yesterday pushing back on extending duration as well. Charles Schwab's Colin Martin coming out and saying the Treasury yield plunge makes extending duration less attractive for them. And then we heard from BlackRock's David Rogel on this program as well, and we had a conversation about the fiscal deficit. We don't want to extend duration too much given the fiscal outlook. So to your point, your view at the front end of the curve, very different to some of the debates, the conversations happening further out.
And just to the point, and I just hear Steve Eisman's voice, oh, the deficit, it's all the people who've worried for their whole lives. There is nuance here. It's not people who are saying that yields are going to blow out sky high and that you're going to see 6-7% 10-year Treasury yields because of the deficit. It's people saying on the margins, we don't understand what that risk premium should be or will be as a result of the fiscal deficit, the fiscal overhang. So why go that far out on the curve? It is a different argument than simply saying the sky's falling. These are not Chicken Littles. These are people who are saying realistically, are we really getting our bang for our buck?
Yeah, we're having a conversation about maybe 50 to 75 extra basis points, as opposed to Eurozone debt-style crisis.
Thank you.
Like two different conversations, aren't they?
Yes.
Let's take it to the FX market just briefly. Take a look at foreign exchange. We'll talk about some of the data coming out of Europe and the Eurozone. 110.98, it's a break of 111, just a weaker euro, just a touch. I've talked about this a few times already this morning. The breakdown of Eurozone CPI. We had the German breakdown, regional stuff. You get these German regions coming out with their individual reads on inflation, just a little bit lower than where we were in the previous month, indicating we could get some more rate cuts from the ECB. But the conversation we had earlier with Terry Wizman, really building on the debate of the moment, I think, of foreign exchange. If you can normalise interest rates in America, if we can narrow so-called rate differentials, is that sufficient to unlock some real dollar weakness? The additional point here, the missing ingredient in his mind at least, is that you need to really rebalance growth differentials as well. And from his perspective, he was making the argument, story in China, not great. Saw some downgrades from UBS, actually, around GDP targets in the last 12 hours or so. Europe, not great. Germany's got difficulties. Now, even in the UK, there's a prospect of a really tough budget coming up later on this year, too, which would put additional pressure on the Bank of England to reduce interest rates. So it's just hard to make that argument that we're going to get that big bout of dollar weakness, at least from Terry's perspective.
Not only do you have potential growth concerns, but there also is this question, where does the next central bank surprise come from? What's priced in right now is a Fed that's poised to move at least 3 times. And an ECB, we're not sure. Because of the growth differentials, he sees a greater likelihood that the ECB could match what the Fed is doing. So he doesn't see any kind of massive surprise on that front either. If anything, more to euro weakness side.
I do have some sympathy with the view, though, that we have built up this massive long dollar position from investors outside of America reaching for yields, and that's pretty deeply entrenched. The yield available in America over the last few years, just totally unavailable compared to what you could get elsewhere.
I'm watching gold. I think it's the preview to a movie that's relevant here.
Yeah, was dollar yen the tremor and not the earthquake? You know, I'd ask that as well.
You know, but even Terry Wizman, who doesn't see that happening right now, so it's a really important point. And he's bullish on gold, and he's watching this too to understand the flows. It just hasn't happened yet, but it doesn't mean it's not going to, so stay tuned.
We can get so bearish so quickly on this programme. Dollar yen 144.62. AMH needs to come back and sort of rebalance this out. Fast.
Oh yeah, she's just Miss Sunshine over there.
144.60. She is right now. She's on vacation. Under surveillance this morning, a revenue beat isn't enough for Nvidia. The chip maker failing to live up to investors' high hopes, delivering an underwhelming forecast and reporting production snags for its advanced Blackwell chips. The stock is down by 4%. Mandeep Singh of Bloomberg Intelligence with us just moments ago, really highlighting margins as a key issue going forward.
That was actually fascinating to me, this idea that the suppliers, the TSMCs of the world, are saying, hey, NVIDIA, you've got plenty of cash. Why don't you spend more of it on the stuff that we're providing to you? At the same time that NVIDIA is getting pushback from some of the end consumers in terms of how much they are willing to spend and face off with price increases. That margin compression starts to eat away at some of their incredible moat of competitive edge and their ability to keep rising prices and margins ad infinitum.
Dan Ives of Wedbush expecting this stock to be positive by the end of the session.
You know, he could be right, because how many people out there are saying they're waiting for a dip to buy? Is this a buyable dip at a certain point?
It's not always the case. They wait for the dip, they get the dip, and then they fear about the next 5% moving in the wrong direction too.
What counts as a dip?
It's always the same.
What's a dip?
For this name?
This
Given
is a
the
dip.
price action on this name?
Exactly.
I don't know if this is. Maybe it's 10, 15%.
Right, exactly.
In a couple of days.
Yes. No, this is the issue.
Anyway, let's turn to the latest from the White House. National Security Advisor Jake Sullivan wrapping up a 3-day trip to China, meeting with President Xi Jinping as both sides look to stabilize relations. The Biden administration announcing an upcoming phone call between the president and his Chinese counterpart in the, quote, near future. Jake Sullivan's been given quite an audience, in the last couple of days, meeting some very high-profile figures.
Which I thought was the most interesting aspect of this. He's going it over at a time where you have a lame duck president, and he's been given a very high audience at a time of a lot of international stress. I wonder how much the discussion is, hey, if you make things easier with Russia and Ukraine, solve some of these problems, then it's likely that you'll have Kamala Harris over Donald Trump. But there's a real question here in my mind, which is, which would Xi Jinping prefer? Honestly, it's unclear in terms of who he wants his dance party to be come January.
They've got some growth issues as well. They've got their own problems. We've talked about this repeatedly. Domestically, Europe and China have their own problems. And you can make the case that Europe is just a derivative of what's happening in China. I mentioned the UBS forecast. So they've now got GDP in China of 4.6% this year, compared to an earlier forecast of 4.9. For 2025, so a year out, UBS now seeing growth at 4%, down from 4.6% previously. And that's the direction of travel for a lot of economists looking at this economy.
So does China try to create better relations in order to be able to export more goods to juice the economy? Or do they become more hardline and go to some more sort of ideological policies and just steer clear of any kind of economic projections? I don't have a clear sense.
Or as some banks have suggested, maybe they're saving some fiscal firepower to see what the outcome of the November election is and what they might have to spend in 2025 to really cushion the economy. Let's talk about the politics. Kamala Harris and Tim Walz sitting down with CNN this afternoon. Top of mind, policy. Heidi Crebo-Rediker of the Council on Foreign Relations saying it's likelier than not that a Harris White House would build out foreign policy with a focus on international leadership, nurturing ties with allies and partners, including NATO, new minilaterals like trilateral with Japan and Korea, and critical minerals partnerships, and the G7. Heidi Crebo-Rediker of the Council on Foreign Relations joins us now. Heidi, let's build on that if we can, and welcome back to the programme. Can I start with this one? You're incredibly well connected in Washington, D.C. I'll say that for you. How much daylight is there between Harris and Biden?
Well, I think you're likely to see quite a bit of continuation in the foreign policy agenda of a Harris presidency. And I think probably the most important area would be the relationship with allies and partners, because Trump has really shown that he's a go-it-alone president. And so, in this day and age, the world is far more complicated than when Trump was president. You have an alignment with China, Russia, Iran, and North Korea in a world where America really needs to lead, but we have to do it with friends and partners, and that includes bolstering supply chains and resilience. You can't do that alone. So I think it just in the broadest sense, you would see a continuation of many of the features you've seen in Biden.
Heidi, when it comes to China specifically and the issues in China, do you think they can make the case that a multilateral approach has been more effective in the last few years than what we saw under President Trump?
Absolutely. I mean, I think, you do have a more complicated geopolitical backdrop where you have China actually helping Russia's war economy, where you have much more cooperation across, as I mentioned, those four key countries who are geopolitical rivals right now. And so you need to have friends, you need to have allies, you need to have doubling down on the existing minilaterals, the new minilateral between the U.S., Japan, Korea, building on the Quad relationship with Australia, Japan, India, and the United States, and also building out the critical minerals partnerships and what we're going to need for energy transition and for defense. And I think also the traditional forums like the G7 take a lot of work, they take a lot of nurturing, and we did not see that during the Trump administration.
Heidi, we were just talking about how unusual it is that Jake Sullivan went to China and got such a high audience at a time where Joe Biden is a lame duck president, and there's a lot of questions around who's actually going to be the head of this country come early next year. Heidi, why do you think he went now and got such an audience?
Well, I think it's important to make sure that there is a channel of communication when there is any change, when there is uncertainty, which is running pretty rampant in the global geopolitical space right now, as well as in the global economic space. So knowing directly from the National Security Advisor what is the likely Harris agenda, what is coming potentially down the pike before the election or after the election with regard to any rumored expansion of export controls, how to manage competition in a way that sustains sort of strategic balance and safety. We have had a number of run-ins with China in the South China Seas and trying to make sure that we don't have any unintended consequences from some of China's more aggressive military actions of late. So I think just maintaining a senior dialogue at this critical juncture is crucial.
Heidi, I think that a lot of people are going to be watching tonight when we hear the first televised interview with a major media outlet of Kamala Harris and her running mate, Tim Walz. And I'm wondering, I'm sure China will also be watching to understand exactly what some of these policies may be, as well as many other international partners of the United States. Heidi, what are you expecting to hear tonight or not? Does it matter if we hear nothing in terms of policy?
So I think this is about politics as well as policy. We're 70 odd days out. Harris is sitting on momentum. She said she'd do an interview before the end of the month. And I don't expect her to really break any new news in this interview, but I think it's an important one to watch. And you are absolutely right. Everybody outside of the U.S. Will be watching this to see if, for any policy insights. And I think this has been a sort of a policy light campaign on both sides. You have, Trump has had this Project 25, tome, outside tomes made by others and not himself on many, many issues. And then, she's not is the first candidate to be light on specifics. I mean, Bill Clinton was criticized for far too little on specific policy issues. And then Secretary Clinton, when she ran for president, was far too specific, and so I think at this stage in the game, we're close. We're really close to Election Day. She has an advantage. Harris has an advantage that she did not have to go through a primary process. She did not have to define her views and take some harder policy positions. So she has this advantage right now, and I think she's not going to squander it. So. And I think I like the fact that she's doing it together with Governor Walz. I think this is going to be an attempt to really show their personalities, human side, the way they interact. And he also gives her the out of not getting cornered by somebody, not pointing fingers, but looking at a press desperate to figure out specifics. She's going to try not to get cornered, and I think that's smart.
Heidi, you said that a lot of people are watching internationally in terms of trying to understand what a Harris presidency would look like. Do you think it will bother them if they get no specifics?
I don't think so. I think, she wants to win. I think that there's been a lot of criticism of not having drilled down on specifics. And I don't really think that she's trying to play to an international audience in this interview. I think this is really a chance for her to talk to the American people and to voters. And so you might hear less on international and maybe more on domestic and what she and Governor Walz would mean for some of her domestic economic agenda items.
Heidi, we've got to leave it there. Come back soon. It's been too long. It's good to catch up. Heidi Crebo-Rediker there of the Council on Foreign Relations. Certainly for domestic consumption later on this afternoon, as it should be.
Well, sure, except is domestic consumption challenging Kamala Harris with respect to policies, or is it just media members who would like some more specifics so that they can analyze them as well as people in the market? It's a good question. We've gotten conflicting remarks on.
You can see Republicans are really frustrated with this. But they're really frustrated with it because it's working.
Correct.
It's working.
And that's why Heidi was just saying, essentially, do no harm. Why should she do anything other than evade, not break any news, show a human side, have her camaraderie with Tim Walz kind of dominate all the headlines, and then move on?
Look out for clips from that in the next 24 hours or so. Let's give an update on stories elsewhere this morning. Here's your Bloomberg brief. Toyota sales eking out a gain for the first time in 6 months on strong demand in Europe and Japan as it faces recall issues in the US. The outlook for the current month appearing gloomy as a typhoon shut down all of its Japanese plants this week. Elsewhere, shares of Dollar General tumbling in the pre-market. The discount retailer cutting its full-year sales forecast, a sign that its turnaround efforts may not be doing enough to fend off competition. We are down in the pre-market, not a typo, down 23.4%. And finally, shares of Best Buy up in the pre-market, the company raising its annual profit guidance in a sign the demand for electronics and appliances could be improving. Best Buy saying they, quote, capitalized on the demand driven by customers' desire to replace or upgrade their products combined with new innovation. That stock is up 7%. And that is another example, Lisa, of the contradictory signals in retail in America.
That's exactly what I was thinking. And can you extrapolate out and say that Best Buy is more discretionary spending for people who are middle to upper income, and that Dollar General is more catering to lower income individuals, and they tend to be feeling the crimp of this economic moment more than others? I'm reading through. It looks like it could be idiosyncratic, a word that I dislike, but it's exactly the point that sticks out to me. Pick your poison. You've got a different story, and that's been for earnings, and that's been for economic data.
It's been the buzzword of the retail earnings season. Idiosyncratic. We've heard it on repeat. Up next on the program, all eyes on the labour market.
I'm not saying that the unemployment rate is going to go into the 5s, but it certainly is pointing to a deterioration and a direction that would suggest a higher unemployment rate.
Just published in Citi, Andrew Holdenhorst, what would cause the Fed to cut 50 if the unemployment rate remains at 4.3 as they project? The Fed will cut 50, or is likely to. If the unemployment rate falls to 4.2%, the Fed might only cut 25 unless payroll growth is also soft. More on that in just a moment. From New York, this is Bloomberg. Equities near all-time, or rather session highs, but still very close to all-time highs. What are we, 2% away?
Yeah, we've been 2% away for a while.
Something like that.
It's
all right, getting ahead of myself. Give me a break.
It's okay. Wait
Up a third of 1%. Near session highs on the S&P 500. In the bond market, 382.73 on a 10-year. Foreign exchange, stronger dollar today. 5 weeks of dollar weakness. This could have been week 6. We're about to snap that based on the price action of the last few days. Euro dollar 110.99. Under surveillance this morning, all eyes on the labour market.
There's been a deterioration in the labor market in the U.S. It seems to be evident in the data that started to come out in the latter part of the second quarter. It has continued into the third quarter. Now, I'm not saying that the unemployment rate is going to go into the 5s, but it certainly is pointing to a deterioration and a direction that would suggest a higher unemployment rate.
So here's the latest. Weekly jobless claims set to provide the latest read on the US economy in just over 30 minutes' time. Lydia Boussour of EY writing the following: unless labour conditions deteriorate materially in the coming weeks, we continue to expect a majority of policymakers will favour a 25 basis point cut in September. We foresee 25 basis point rate cuts in September, November and December. Lydia's with us for more. Lydia, welcome to the programme. I just want to build on some of that, the kind of numbers that would be required, a prerequisite, if you will, for a 50 basis point cut on September 18th. What would you need to see today, this morning, and again on September 6th?
Good morning. In terms of what we would need to see for that 50 basis point rate cut to be on the table, you would need to see a continued deterioration in labor market conditions. When we look at the jobs report for August, job gain below 100, and a continued uptrend in the unemployment rate would likely put that 50 basis point rate cut on the table. We would also need to look at other labor market indicator. I think the focus is going to be on the jobs report, but the Fed is going to be looking at the totality of data. They're going to be looking at the JOLTS data as well. If we were to see that material deterioration in the labor market materializing, I think that would put that 50 basis point on the table. At the same time, we know that some Fed officials are more reluctant to go with, bigger rate cuts. We know that, there is a divergence of views with some Fed officials favoring more easing. We know that a 25 basis point rate cut was on the table at the July meeting. So I think what you're likely to see is the consensus converging towards that 25 basis point rate cut in September.
Let's sit on consensus. The median estimate in our survey for payrolls is 160. We've only got 7 estimates so far. That number could shift, things could change. But Lydia, let's go with 160. Given the recent revisions, shouldn't I just chop off 70 from whatever the number is and go with that?
The revisions that we've seen, over the past, over last week, the revision showed essentially that job growth was softer than expected, but job growth was still positive. And I think that's important to remember. We're still in an environment where the labor market is not retrenching. We've seen a slowdown in labor market gains. And what we have to keep in mind is that this slowdown has been playing out for a number of months. We've seen that gradual slowdown in job growth. We've seen, the moderation in job openings. We've seen less labor market churns. And most of the labor market indicators have been pointing to this gradual softening in labor market conditions. I think the key question is whether we continue to see that gradual softening in labor market conditions or if something more serious materializes. And so we'll be, looking at that. And if we were to see that playing out, that's going to lead the Federal Reserve to consider a faster pace of tightening. But given the current conditions that we're looking at today, which is still a gradual deterioration in labor market conditions, but an economy that's still showing resilience, I think the Federal Reserve is going to err on the side of caution and go with 25 basis points at the next few meetings.
Just quickly here, we just have about a minute left, Lydia. How concerned are you about the "this time is different" moniker that people are talking about, given the fact that what we're now pricing in is something that historically is an anomaly?
Yes, the Fed has been, lucky enough to have that combination of resilient economic activity and bring inflation closer to the 2% target without inflicting too much pain to the labor market. I think what's encouraging is that we're now seeing the Fed ready to lean against that labor market risk. We've heard it last week with Fed Chair Powell mentioning the fact that there is ample room for policy to respond in the event of a material deterioration in labor market conditions. So that's going to be very important. The Fed essentially showing willingness to lean against that labor market risk.
Lydia, we've got to leave it there. Lydia Boussour of EY ahead of jobless claims later this morning. About 35 minutes away now, Lisa, the next big stop for this market.
Yeah, and I wonder how much people are actually watching this or whether people have just seen it remain stagnant for quite a while. What do you think would be a bigger surprise, upside or downside?
That's unfair. For this market right now.
Yeah, what do you think?
What would freak it out more?
Yeah.
I think a big upside surprise.
You think so?
Oh, yeah, the kind of weakness that would change the conversation.
Yeah,
that's what we got August 2nd,
yeah,
right?
I think you're right.
Like, that's a guess.
Yeah,
that's a guess.
It's weakness, it's not strength.
Don't get me into trouble. I thought good news was good news and bad is bad. Aren't we rolling with that?
Maybe.
Okay. Coming up on the programme, Anastasia Amoroso of iCapital, William Stein of Truist, Michael Pugliese of Wells Fargo, and Earl Davis of BMO.
We are in a fairly sweet spot that's been priced decently into the market.
This is an environment where you have to look at the fundamentals.
We think investors should go into a more diversified, multi-sector approach.
This market is driven by fundamentals, and it's not a gimmicky rally.
We're still having the mother of all debates between the bulls and the bears.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Things are a little bit calmer. 30 minutes away from jobless claims, 90 minutes away from the opening bell. Equity futures are positive by 0.25% and near session highs. On the Nasdaq 100 up by, let's call it 0.25%, with Nvidia in early trading, erasing yesterday's afternoon's losses, that's for sure. Negative by 3.4%, but still plenty of conversations, Lisa, about supply side difficulties and what may or may not happen further down the line on the demand side.
What I find interesting is this is a tempered and rational market. People who are expecting that 10% move, although we can see there is quite a bit of volatility still in Nvidia, just to me the fact is people are looking at pricing out multiples. This is not about a wholesale fear or Armageddon or a broader commentary on markets, which is the reason why you're seeing calm this morning, even with Nvidia failing to blow expectations out of the water.
Not exactly a great read on the economy either, given how many times we're told this is like the secular growth theme of the moment. So let's talk about the economy. Jobless claims 232,000 is the number that we're looking for a little bit later this morning, bang in line with what we heard the previous week of 232. Now, we've all got the same question. What would it take for this Federal Reserve to go with a 50 basis point rate cut on September 18th versus, say, 25? Well, I can show you the estimates for payrolls next month. Payrolls next month is about 160 on headline, and we're actually looking for unemployment to come back from 4.3 to 4.2. That's the median estimate so far. Andrew Honhorst of Citi just published moments ago. He said you stay at 4.3, they go 50. You drop to 4.2, more likely to go 25.
That scenario would be supportive of what we're seeing right now in markets, which is the Fed would go potentially more significantly, even without some sort of dramatic downturn. That, to me, is the real big question. You could make the argument about 25 to 50, but to me, it's sort of what do risk assets do with these rate cuts? What do risk assets do with an economic backdrop that people are just assuming will be benign? To me, it's less about the Fed's trajectory at this point and more whether there'll be good cuts or bad cuts to a market that is very much hedged to a soft landing.
It's bad news, bad news. You know, I asked the question about 15 minutes ago, and I know it's a little bit snarky. Do you think there will be some people that just take whatever the payrolls number is and just drop 60 or 70,000 jobs off it because of the revisions we've had over the previous year? Why wouldn't you?
I think that that's actually completely legitimate, especially because there was actually a story out in the Bloomberg this morning talking about how regional Fed surveys are starting to show some real risks to the U.S. job market. So the peripheral commentary highlights some of this weakness in a way that makes people wonder how accurate some of these surveys are, especially because response rates haven't been as great.
Yeah, this is the bias, I think, at the moment. You see a strong number. Is it strong? You see a weak number. Must be really weak. And that's going to be the fear going into payrolls.
Which is the reason why, to your point, I very much agree with you that an upside surprise, a significant upside surprise to jobless claims would very much have a disproportionately large influence and a negative one on equities and other risk assets than, say, a lower than expected number where people could just shrug it off and say, well, you know, these are noisy numbers.
Equities right now, positive, 0.25%. All of that still to come. The number drops in 26 minutes' time. Outside of equities, into the bond market, Lisa's going through some of the supply we've had through the week. The 2-year went okay. The 5-year a little bit softer, relatively speaking. A 7-year auction, Lisa, later today.
$44 billion worth. We'll check it out and see whether we see the same kind of just general softening around the margins. Not trying to paint this with overly dramatic overtones. The point to me really is you get the sense people are willing to move out the curve 3 to 5 years. Are they willing to go beyond that, given some of the other concerns and the fact that we haven't gotten an answer from Fed officials or anyone else about what the neutral rate actually is? Where is the stopping point here?
Yeah, not just the concerns about the fiscal deficit, but also the rally that we've already seen at the longer end of the curve. And the argument that we heard just yesterday, that you need the curve to normalise to really unlock that cash at the front end of the curve. You've got to incentivise them to go out along the curve with a high yield. That's the view we've heard from a few people on this programme. Was it BlackRock yesterday that made that point? I think it was.
And Charles Schwab, this idea that he really enjoyed 10-year yields at 4.2%, at 3.8%. Maybe you can hold it for the carry, but it's not going to have the same kind of massive price appreciations just given where we are.
The 10-year right now, 382.73. Coming up this hour, we'll speak to Anastasia Amoroso of iCapital as investors reassess the AI frenzy post-NVIDIA earnings. William Stein of Truist on why he's still bullish on the chip giant. And Michael Pugliese of Wells Fargo on why the worst is yet to come for the labour market. We begin with the big issue, the make or break moment that was just a little bit more break than make. NVIDIA disappointing investors with a weaker than expected revenue forecast, dampening the outlook for tech stocks as investors begin to question how long the AI party will last. Anastasia Amoroso of iCapital is with us for more. Anastasia, get super tactical, short term if you want to. Is this a buying opportunity for you? Is this some weakness you'd lean into?
I think it is weakness to lead into in the semiconductor space. I mean, John, it's interesting that you talked about this being maybe a break moment for NVIDIA. I probably wouldn't characterize it as such. I think it was a strong earnings report, but against very elevated expectations. What investors have gotten used to is that NVIDIA delivers blowout earnings reports and then overnight follows a slew of analyst upgrades to the stock prices, and that's what drive it higher. That's not what we got. We got a small, modest beat and raise quarter, and it didn't have the follow through that you typically have in terms of upgrades. So that's why it's called a disappointment, but it's a disappointment relative to very high expectations. But when you take a step back from that and you say, does this mean the AI investment cycle is not happening? Does this mean the economy outside of NVIDIA is weak? And the answer to both of those things is no. The AI cycle is absolutely happening. And it's not just NVIDIA that's participating, by the way, in the AI CapEx cycle. It's a lot of other companies. And we've heard from the likes of AMD and Taiwan Semis that this trend is still very much ongoing. We've heard that hyperscalers are investing and sizing up their investments in AI CapEx. So this is why, John, I would use this moment of weakness, by the way, I think about 50-day moving average, to step in and add to this important trade.
You talked about some of the chip makers, and then you talked about some of the customers. Can we sit on the customers? Do you think they need to demonstrate in a much bigger way in the coming quarters a bigger return on investment, given this big ramp up in CapEx we've seen over the last year?
Well, I think they do. I think that's why when I think about what places of the AI trade I would be buying, I don't actually lead with some of these hyperscalers because it's exactly right. They're going to be the ones that are outlaying the cash in order to make this investment. And the return on investment may follow, but with a lag. Now, you can't carry this forward and say, well, does the second derivative mean that they will slow down the investment and that's going to adversely impact the semiconductor chips? And I think the answer to that is no, because as we've heard from the likes of Meta, is that the hyperscalers would rather overinvest right now, waiting for that return on investment. So I think that's an important distinction. And that's why I very selectively say I would step in and buy the semiconductor space, because I think they're going to continue to benefit from this investment cycle. And John, just another nuance there. There's the AI trade within semis, but there's also the broader cyclical uptick in units sold in semiconductors. For the last year or 2 years, we were running at negative year-over-year numbers in terms of unit revenue, but we just flipped into year-over-year positive territory. And I think there's more to that. And we've also heard from other semis this reporting season that they have seen some demand uptick in auto and industrials and other sectors. So that's why I like this combination of AI still very much intact, but also potential for cyclical pickup in semis to continue.
Anastasia, so deliberate in your words. The idea when John asked, is this to buy the weakness for NVIDIA? You said, yes, you need to buy the semiconductor space. I'm just wondering whether this is really a moment where the high flyers, the ones that you're not as interested in getting involved with, or that you will be sort of holding, but not necessarily adding to the hyperscalers or the NVIDIAs of the world, whether that trade I don't want to say is over, but it's sort of seen its biggest gains. And now it's really the broadening out that so many people have been waiting for, the people who are using the technology, the suppliers to, say, NVIDIA, that are able to raise their prices because NVIDIA has so much cash that they can keep unleashing. Is that kind of the way you look at this trade now?
That's right, Lisa. I think we have seen the bulk of the earnings surprises for some of the mega cap companies. And if you look over the last year and a half, that's what's really driven their performance, just the magnitude of their surprises, where nothing else was really surprising to the upside. But as we look towards the year, and by the way, as we look at this earnings season, we saw the companies outside of the Magnificent Seven delivered earnings that were double what the forecasts were. They delivered something like 9% year-over-year earnings growth versus 4% that was expected. So that's why I do expect more market-type performance from some of these hyperscalers. But I do agree that looking within the supply chain, and by the way, a lot of the analyst notes that came out following NVIDIA were talking about the positive read-throughs to the tech ecosystem. So that's where you have to look, is within the hardware, within the optical equipment, within the rest of the chip space. But the other point, Lisa, that you brought up too, is that there is a broadening out. As important as NVIDIA is, it is just not as important as it was, let's say, a year ago to the broader market, because we have seen stocks like utilities, for example, financials, regional banks, as well as small caps, hold up a lot better than the tech trade has. So that's where investors are really focusing on right now, is how do they position for the thing that we know is coming next month, which is the Fed delivering its first rate cut.
Anastasia, do you think that it's sort of a question mark as to why the Fed is suggesting a significant rate cutting cycle at a time where other companies that are more leveraged to the economy seem to be doing better? And we haven't really seen that weakness, even in what we're expecting to see in 19 minutes' time?
Well, the Fed has to look at the unemployment rate and inflation. And if they look at those two things, certainly the rate cutting cycle is warranted. Inflation has come down a long way. And of course, we get the core PC number. Tomorrow, we're looking for 2.6%. That is a far cry from where we were and very close to the Fed mandate level. And then if you look at the unemployment rate, there has been obviously weakening and loosening in the labor market. And probably the biggest takeaway from Jackson Hole for me last week was the fact that Fed Chair Powell is now not welcoming any further weakening in the labor market. So that actually provides even more potential support for equities, because it means that should we see further weakening, the Fed will be likely to step in and maybe do so in more full force. And Lisa, then the last, not official mandate, but also if you look at where the real Fed funds rate is, close to 3%, 2.75, it is well above and over what the neutral rate is. So the Fed has a lot of basis points of rate cuts to potentially work with. So why not start with some of them, given that they're actually fulfilling the mandate right now?
Anastasia, appreciate it. Anastasia Amoroso there of iCapital. Using this as a moment to lean into this weakness, just a little bit of weakness when it comes to the likes of NVIDIA. How many times have we heard this? The Powell shift, the Powell put is back. Neil Dutta, RenMac, said it repeatedly.
Yeah, well, this is basically what you're seeing priced into the market. What I also thought was interesting, what she just said, is the high flyers retaining their mantle as the high flyers. I don't want to say it's over, but it's getting there. And that's the reason why the broadening out trade is continuing to gain steam, even without the participation of NVIDIA. That, to me, is one of the question marks that I have. How much is that going to be the recognized idea that, the Magnificent Seven are not going to be the Magnificent Seven in the upcoming 12 months?
Jobless claims about 17 minutes away. That will build on some of the story, some of the things we're talking about here. 232 is the estimate in our survey. The previous week, 232,000. Let's get you an update on stories elsewhere. Here's your Bloomberg brief. The FBI providing more information about the attempted assassination of former President Donald Trump. Officials saying the gunman had searched information about explosives over the last 5 years. Investigators have conducted nearly 1,000 interviews, but still do not have a motive for why the 20-year-old shot at the former president. The Netherlands planning to restrict ASML's ability to repair and maintain its semiconductor equipment in China. The decision coming after pressure from the US and is a potentially painful blow to China's efforts to develop a world-class chip industry. And finally, shares of Supermicro Computer falling in pre-market following yesterday's 19% plunge. The company saying it will delay filing its annual financial disclosures and will need additional time to assess its internal controls. We're down another 4%. Lisa, talk about red flags in the last 24 hours.
Well, yeah, especially after an activist investor went after them saying that they're not going to file their 10Ks after the Hindenburg report talking about how they were overstating certain aspects of their business. Not a great look, and the market's responding accordingly.
Yes, sound now, ask questions later,
exactly.
and hopefully get some answers. Up next on the programme, the morning calls, lots of NVIDIA for you, plus William Stein of Truist, who's still bullish on that name. From New York City, this is Bloomberg. One hour, and let's call it 13 minutes away from the opening bell. Futures up by 0.2%. Just a little bit of a lift there on the S&P 500. Let's get to some morning calls for you with one stock in focus, NVIDIA. First up, JP Morgan raising its price target to 155 from 115 and keeping an overweight rating. The analyst saying the company maintains a 1 to 2 step lead ahead of competitors. Next up, Raymond James raising the chip maker's price target to 140 and maintaining a strong buy rating. The analyst noting that Blackwell delays seem better than feared. And finally, Wells Fargo raising its price target on NVIDIA to 165, keeping its overweight rating. The firm finding it hard to see negatives in earnings and guidance and recommending buying the pullback. The size of it right now, we're down by almost 4%. Joining us now to discuss is William Stein of Truist, who has a buy rating on shares of NVIDIA. And William, you upgraded the price target going into the print and lifted a price target coming out of the print as well. What did you like coming out of those numbers just yesterday?
Sure. I mean, look, it's easy to look at the stock action, especially immediately following earnings, and say, oh, something's terrible here. It actually takes quite a bit of hunting to find the problems, right? They beat on revenue. They beat on earnings. They beat on revenue and earnings in the outlook as well. So if you're consistent in terms of applying a multiple to the stock, you'd be raising price targets here. So this is our checks revealed that demand was very good, and that's what actually came to fruition, and that resulted in this price target increase.
William, can you build on some of the supply difficulties, and then we can talk further down the road about potential demand problems? The supply difficulties, are you encouraged by the interview that we had with the CEO, Jensen Huang, sitting down with our colleague and good friend, Ed Ludlow, that ultimately supply is going to pick up and everything's going to be okay? Was that sufficient for you?
No, I think even the quarter was sufficient in this regard, right? So they announced that there was a mask change in Blackwell. And there's some debate as to whether this is really a delay or not. From my perspective, I don't consider it a delay. From my point of view, it's sort of similar to my telling you all that I'll show up at 8 o'clock, and I show up at 8 o'clock. The fact that I got up late, burned my breakfast, had to change my clothes twice, all that sort of, is in the background. If I show up on time, I show up on time. And I think that's exactly what's going on with Blackwell. It's still ramping in Q4. There's no revenue air pocket. Having to redo masks along the way is not some very unusual process. It's just, I think someone got wind of this. It wound up getting a lot of attention in the press. So management acknowledged it on the call. But I don't think this is some unusual consideration in semiconductor manufacturing, especially considering how sophisticated the processes are that NVIDIA is deploying.
Let's extend the metaphor. Let's say there is somebody who always wakes up on time, always has a perfect breakfast of a protein shake and an omelet, and always gets there at 7:55. And then suddenly this person burns his breakfast, wakes up late, and gets in just at 8 o'clock. People start to lose faith that they'll be able to keep showing up at 8 o'clock. And I think that is the fear with NVIDIA. How much can they depend on this company to continue outperforming at a time that they're facing off with new competitive landscapes, as well as higher input costs from the suppliers that are raising their prices?
I think that's an excellent follow-up question. Look, I don't think that there's a question about NVIDIA's ability to deliver. I don't think that's what's come into question here. Are the transitions from architecture to architecture going to be as smooth and flawless as perhaps Hopper was, or another one that went, perfectly well? They're not all going to be like that. I don't think it calls into question NVIDIA's ability to manage those transitions. They've done it many times in the past, and I think we have many more to come in the future. I don't think that's really the question. But I think the second part of your question is really the issue here, which is there seem to be some higher costs. And I think that's the effect that the mask change had. I think that's part of what's causing this gross margin degradation in Q3 outlook and the implied comments about Q4 gross margins. I think that relates to the Blackwell mask change, but also increasing input costs. And I think that is the one legitimate gripe about the quarter. If you're searching for the problem, you're searching for why the stock is down, it's the gross margin downtick in Q3 and then bigger downtick in Q4. And I think it relates to Blackwell, but it also relates to input costs. I think TSMC is probably trying to take a little bit more of the margin stack here. And high bandwidth memory is also, a higher input cost as well. And I think those are the factors.
William, can we recast the move in markets? Less as, say, the bears coming out of hiding and slamming this company, and more people wondering how long this company can keep performing just out of this world incredibly and continue having astronomical stock price increases. In other words, how do you justify a valuation at this level, given how much we've already priced in, and can they grow to that expectation? What gives you confidence that, yes, they can and then some?
Sure. So this, I think, is relatively easy to answer. For very rapid growth stocks, we'd expect to see an even bigger multiple. People ask, is it priced for perfection? That's similar to what you're asking me. I think this is now trading below 40 times, certainly maybe 35, 36 times out year earnings. That is not a multiple that implies perfection and unbelievable growth. Are we seeing growth fade here? Certainly. They're not going to grow at 250% forever. They're not going to grow at 150% forever. A high double-digit growth rate is amazing for a company this large. And we think that is something that can persist over time. Let me take the other side of it, though. Is there going to be a period where they slow down and post negative year-over-year growth? With certainty, that is going to happen. We don't think it's going to happen in calendar 25, but it happened very recently before this big growth spurt started about a year ago, and it will absolutely happen again. We just don't think it's happening right now, and we think it's very easy to justify 40 times earnings for a stock growing at this pace and having this sort of forward look on their business in AI.
William, just finally, before you go, if you've got a decent framework to help our audience, just a historical parallel for what you think this moment is like. That's tough for me. It's hard for me to tell you exactly what the parallel is. To me, this is just people over-interpreting the effect of a gross margin stutter step. We do think they'll work through that problem. And we think the revenue growth trajectory is very strong for this company. We would buy the weakness today. William, thank you, sir, for showing up at 8 o'clock. Appreciate it. William Stein there at Truist. And I hope you didn't burn your toast. That's really important. Bramo, what did we hear from Dan Ives? Like gold rush moment?
Oh, yeah.
Yeah, that's what he thinks this is.
Yeah, Industrial Revolution.
Yeah, all of that.
The railroads. Talking about the advent of the telephone. Maybe an Edison moment of the
Internet.
light. Yeah. I mean, internet's almost like small potatoes. No, but truly, I mean, it's potentially going to revolutionize things. I really would like to get a better handle on exactly how. And I think a lot of other people would too.
Truist, buy the pullback. Wells Fargo, buy the pullback. We've heard this repeatedly. Raymond James, Blackwell delays better than feared. Buy the stock. JP Morgan, 1 to 2 steps ahead of competitors. Anastasia Amoroso, iCapital, moments ago, buy the weakness.
Well, Anastasia Amoroso was buy the weakness, meaning buy the weakness in other companies related to the semiconductor trend. It wasn't necessarily buy NVIDIA. And that, I think, is important. How much do you need to see that broadening out to fuel the ongoing gains that we have seen in NVIDIA?
It was very, very specific.
Yes.
Coming up next, jobless claims just around the corner. We'll catch up with Mike Pugliese of Wells Fargo Earl Davis of BMO just around the corner to react. And Mike McKee will give you the numbers from New York. This is Bloomberg. One hour away from the opening bell, equity futures up by, let's call it a third of 1% on the S&P 500, up a third on the Nasdaq 100. The next stop for this market, seconds away, 15 to be precise. Jobless claims just around the corner. Mike McKee's in the studio. He's ready to break this down. The scores in the bond market, 2-year, 10-year, 30-year, shaping up as follows. A 10-year at 383.30, a 2-year at around 386, 385, 88. With your data, here's Mike McKee. Good morning, Mike.
Well, we get a little bit of an improvement in jobless claims, 231,000. That's down from 233, the revised number from a week before. Continuing claims, 1,868,000. That's up just a little bit from 1,855 the week before. That's 2 weeks before, of course, with continuing claims. So at this point, what we're looking at is a jobs market that hasn't changed a whole lot. And that should give the Fed some reassurance. Other numbers out right now. GDP, the second revision, first revision, second output from GDP goes up, which is a bit of a surprise. It was expected to be unchanged at 2.8%. Instead, it's 3% as personal consumption. Americans are spending a lot more, goes up to 2.9% from 2.3%. A very interesting change there. The GDP price index, 2.5%. That's up from 2.3, and the core 2.8, down from 2.9. Probably those numbers aren't going to really affect the Fed since they were second quarter numbers. They are revisions, and tomorrow we'll get the numbers for July, which will give us the latest data overall.
Mike, put it all together. Growth decent, claims contained. That's a recipe right now, the ingredients for this market to look okay. Equities up 0.4% on the S&P 500. Good news is good news. Check out the Russell. At least the small caps up by 0.8%. That's where your outperformance is in the equity market. In the bond market, yields up 3 basis points at the front end of the curve, approaching 390 all over again. And just to exacerbate the trend of the morning so far, dollar strength, euro dollar down to 110.79.
Everything is awesome. I mean, look at this data. You've got disinflation, more disinflation than we thought when you look at the revisions to GDP and core PCE. Initial jobless claims come in bang on line, but when you take a look at continuing claims, they went down notably across the board. It was revised downward for the prior month in terms of continuing claims, basically in line previously. There is no sense that the economy is falling off a cliff or that the employment market is falling out of bed, which raises the specter of the right kind of Fed rate cuts that a lot of people are expecting.
We'll get another read on claims next week, going into the payrolls report for the month of August on September 6th. Mike, help us settle a debate here. I'm going to tee up 2 quotes, one from Morgan Stanley and another from Citi. And the debate is over the weather. Yes, really, the weather. Morgan Stanley are looking for 185 next week on payrolls. And they say in the weakness of the July jobs report, some was weather, some was noise, some was the slowing trend, but we expect a partial reversal in payrolls in August. Citi said this, Mike, the multi-month rise in the unemployment rate is not a weather-related distortion or the consequence of surging labour supply. It reflects a slowdown in hiring, which will likely continue and eventually worsen into outright layoffs. How do you view this weather debate?
It doesn't seem. There's a question about whether Hurricane Beryl in Texas affected the figures during the month of July. And generally, the BLS says it didn't. Generally, economists have come to the view that it probably didn't, but there could have been other weather effects because there was a large number of people who were off work because of weather who didn't show up in the jobs numbers from Texas. So there may have been other areas of the country where there were weather issues. The biggest issue is that there was a big rise in the number of people who were on temporary layoff. And that may have been connected to automobile retooling factories. We will see if that reverses. If that reverses, then we get a better number. And that's kind of what the consensus is looking at this point. But let me just say this. It doesn't matter. I mean, as long as we get a reasonable number, it's the unemployment rate that's going to matter to the Fed. And whether or not, and this gets back to what Morgan Stanley said, whether or not it's because if the unemployment rate goes up, it's because more people enter the labor force or because companies are starting to lay people off. And the claims numbers don't suggest we're seeing layoffs.
So John said something earlier, and I thought it was a really interesting point. It was an astute point that how much are people looking at this data and are going to be looking at the jobs number and just subtracting 60 or 70,000 from that, given where the revisions are. And I think that that's a valid point in a broader context as well. How reliable is data that is moving around a lot? I'm looking right now at personal consumption, the second revision of the second quarter results was revised to 2.9% from 2.2%. These are pretty big revisions for a second time around, and it's something that we've gotten used to pretty much across the board.
Well, they do their best, but the problem is that response rates have gone down, and the pandemic created unusual situations where we haven't seen data come in the way they used to do that. The BLS and the BEA are trying to change some of the statistical methods and get private sector data in to try to make this more accurate. The bottom line is the Fed has to deal with the numbers that it has, not the numbers that are eventually going to be revised. I don't think I would subtract 68,000 or whatever from the numbers, because that's based on what was happening through March of last year or March of this year. And we often see that revised again between August, when we got that number, and January, when they actually apply the figures, and it's usually revised lower. So 818,000 may turn into something lower than that. There are some, Goldman Sachs thinks it'll go down to 300,000.
So I should take off 90,000 on the payrolls report next week?
No, they think it'll only be 30,000, so you may take off 9,000 or something like that. Let me just mention here,
You
profits.
confused me, sir. I'm confused now.
I think it makes sense that they think that it's a smaller revision downward. Either way, we just have doubts about the numbers. That's the point. Carry on.
Profits, since we're all talking about NVIDIA and 50% margins isn't enough. Second quarter profits, this is the first time it comes out in the GDP numbers, up by 46.4 billion for domestic financial corporations. For regular corporations, profits up by 57.6 billion in the second quarter. That was a decline of 47.1 in the first quarter. So companies made more money. The economy was better. Companies made more money. This includes everybody, including private companies, not just public companies.
Mike, thank you. This is the data we've got. Let's start with jobless claims, 231. The estimate, 232. Previous week, a revised 233. Jobless claims are contained. Equities off to the races again, up by 0.8%. On a Russell, the small caps outperform. On the S&P, up a third of 1%. In the bond market, 2-year, 10-year, 30-year, yields creeping a little bit higher following that economic data across the curve. On a 2-year at the moment, 387.53, up a single basis point, 385 on 10s. Up a basis point, push that through foreign exchange. You have got a stronger dollar, a weaker euro, 108, or rather 110.85, 11085. We're negative by a third of 1% on that currency pair. Joining us now to weigh in on the data, Michael Pugliese of Wells Fargo. Michael, your view on the jobs data so far. I think people can make the case that maybe payrolls have overestimated the strength of the economy. Can you make the case that claims understate the weakness? Because right now, 230, it's hard to make this stuff up. Jobless claims look pretty decent.
Yeah, the way I think about it, John, is there's clearly been a slowdown over the course of the past year or so, and you see this in all the labor market data. You see it in payrolls, you see it in the rising unemployment rate, you even see it in claims, which have ticked up some over the course of the year. But it's been orderly, right? It's been a gradual, orderly, and fairly controlled cooling in the labor market. And I think when I hear Fed Chair Powell and some others talk on the FOMC, their concern is any further weakness that starts to get a little more nonlinear, right? It's cooling gradually until very suddenly it's not. And so far, so good. I think we see that pretty much across the board, that gradual slowdown. But the worry is, what if it starts to become nonlinear in unemployment, in claims, and you see much broader layoffs than we've seen so far?
Michael, how reliable is this data? We were just talking about that with Mike McKee, this idea that we have seen some pretty big revisions. There are fewer respondents to some of these surveys, doing the best they can, but kind of getting messy.
Yeah, the data is certainly reliable. It's revised, and that's always been the case. So the revisions have gotten a little trickier post-pandemic for some of the seasonal related issues and pandemic-related issues Michael was talking about. But just more broadly, I think it's important not to miss the forest for the trees and what's happening on trend. We very well might get a bounce back from the very weak July numbers we got on NFP and then unemployment rate. Maybe it's weather, hurricane related, maybe it's something else. But the trend is very clear here. in payrolls, in the unemployment rate, even in the survey data. Look at the last consumer confidence report. More consumers reporting that jobs are scarce, fewer consumers reporting that jobs are plentiful. And when I look at the totality of the data there, I think that's very reliable. Even if week to week in claims or month to month on payrolls, you get this noise from a whole bunch of factors.
I guess there's this question also for people who are concerned about this time is different and that sort of existential fear that it never happens in a linear fashion, which you can really feel at the Federal Reserve. I just wonder going forward whether the strength that we're talking about when you add 200 basis points of rate cuts through the end of next year, whether we start to worry about a reacceleration in inflation again, or whether that's truly off the table, whether people really believe we are back to pre-pandemic norms.
Yeah, and that's the tightrope the Fed is trying to walk, right? It's ease enough to keep this expansion going, but not so much they find themselves back in the same problem that they had a year or 2 or 3 years ago, right? You heard Raphael Bostic highlighting that yesterday. In his view, he really doesn't want to be in a situation where they have to hike again. I don't think that's real likely. I mean, inflation's at 2.5% right now, and I think given the slowdown in demand we're seeing, that'll continue to decline for both bottoms-up and top-down reasons. But shocks happen, right? Geopolitical shocks happen. You get commodity price spikes. We've got an election coming up in a few months where maybe fiscal policy changes a whole lot in 25 and 26. So the Fed still has to be on guard, and I think that's why they want to proceed towards neutral, but not necessarily to accommodative Fed funds rates of 1-2% like you'd see in a recession.
Adam Posen has made the point in the Financial Times from the Peterson Institute, Michael, that maybe they should be prepared to pivot from the pivot if the former president gets another term because of issues around immigration, because of issues around tariffs as well. Do you think the political considerations are strong enough that that might actually be an outcome in 2025?
Well, I think what the FOMC is going to have to do is just wait to see what happens. When you go back to 2016 as an example and look at what they were talking about after that election at the December meeting that year, they weren't sure. They didn't know if we were going to get a lot of fiscal stimulus via tax cuts, and they didn't know what some of the policy changes were going to be, and so they had to proceed with some caution, and that's what you saw, and I think you would see something similar. I don't think you would see a kind of proactive knee-jerk response because there would be uncertainty about changes related to trade policy, tax policy, spending policy. But, for example, if you got a fiscal policy change, more spending, lower taxes that gave you faster economic growth and faster inflation, then I would expect a Fed response.
Michael, thank you, sir. Michael Pugliese of Wells Fargo on the latest. Adam Posen says don't wait. That doesn't mean act. It means start talking about it. He reflects on a period of time which was, I have to say, incredibly controversial at the Bank of England under Governor Carney, when Carney at the time weighed into the Brexit debate and said what it could mean for the supply side of the economy. If I remember the language used correctly, it was something like the speed limit of the economy would shift. We'd be more prone to inflationary shocks because of the supply side issues. It was a view at the Bank of England that ultimately this could be a scenario. This is what we think about said scenario. This is our belief. Adam thinks the same thing should be happening at the Federal Reserve with regards to the politics of the next year or so. And like I say, that can be incredibly controversial because you're wading into a topic that there are a certain set of individuals just don't want you there at all.
There's a discussion, an economics discussion around tariffs that's not being had in open, where people really lay out exactly which tariffs could be potentially really negative. I mean, you are seeing it on the margins from certain think tanks and such, but not from Fed officials, because it becomes so political, and then they worry about political independence and fears of accusations on that front. Nonetheless, you have to imagine that in the regional Feds, certainly, they've got to be doing scenario analysis here because that will absolutely affect how they look at rate policy next year.
If you are just joining us, welcome to the programme. Equities doing OK, up 0.25% on the S&P 500. Some real outperformance on a Russell. The small caps up by 0.8%, something like that. If you look to the bond market, we look like this on a 2-year and a 10-year. Yields creeping a little bit higher, up by 2 basis points on 2s, on 10s, up by 3. All of this off the back of jobless claims coming in, basically in line at 231. The estimate was 232, and we said a meet is basically a beat for this market. This is what this market wants to see, just contained jobless claims.
Yeah, contained jobless claims and upgrades to the GDP revisions, as well as downgrades to the inflation reads from the second quarter. It basically is the perfect scenario. This is basically soft landing nirvana.
Earl Davis of BMO joined us for more on that. Earl Davis, unequivocally dovish, your view of Chairman Powell last week. It's time to go long anywhere on the curve. Oh, can you build on that? Why anywhere on the curve?
Because what we'll experience actually is going to be a bull steepener, which means, your 2 years will outperform your 10s and 30s. But it's actually our preference to go long 10s and 30s because the volatility in 10s and 30s will be lower. So from a Sharpe ratio or a risk-adjusted ratio, it makes more sense to go long 10s and 30s despite our steepening bias.
This time yesterday, we caught up with Charles Schwab, Colin Martin. He said the Treasury yield plunge more recently makes extending duration less attractive. Oh, how do you think about that, just the valuation proposition?
Yeah, you know what? I fully agree with that statement. That's why we're only, call it a 5 on 10 long the market. But the thing with this market, although valuations have gotten arguably ahead of themselves for now, you never know when the next spike lower will be. As I like to say, I've been in the market for 30 years, and you know what? If timing was my strongest suit, I wouldn't even be on the show right now. I'd be on the beach somewhere. But I always want to make sure I'm in the position I want to be. But we're looking towards 4%, where we really add to our longs and go full in long in 10-year yields.
You'd be calling us from the beach. I know, Earl. You'd be calling in. You'd be wanting to talk
for what
with
it's
us.
worth, Bram, Earl, I wouldn't be here either. Right there with you.
All right, moving on. You said something that volatility is less in 10s and 30s, and that's one argument for going into them. Is that true? I mean, at a time when a lot of people are talking about a sort of new environment for yields more broadly, but especially duration, of more volatility there, especially with the election coming up.
Yeah, you know what? I didn't say there's going to be no volatility. There's going to be volatility everywhere. But this is why I love being an active manager. This is why it's perfect time to be in the shoes that we're in. We have our expectations. As I said, we do expect yields to go lower. But the market, we also expect it to go higher. But that allows us the opportunity to get long. This is the difference between passive and active, and it's the perfect time from an active manager perspective to monetize that volatility. And our team has been doing that for the past 2 years. You've heard us with the 2-year trade before. That was an example of volatility in the 2 years. Now we think we'll see it in 10 years, and we can monetize it there.
Is there a contradiction in this bullishness across the curve in bond markets? Is there a contradiction with the strength of the economy that we're seeing?
No, there's no contradiction. Actually, it's very similar to the weather argument that you brought up before in regards to the employment number. I would expand that weather argument to the markets. There's so many credible, plausible outcomes in this market in regards to rates higher, rates lower. But this is why it's important from our perspective as an active manager. Don't get caught on where you think rates will go, because you're going to miss the volatility, and that's where you can monetize. So I think all the arguments are credible. Our team, we have a process where, it's been validated in regards to outlooks and views. And that's why we do see lower rates from here. But it's not going to be a straight line lower as we're seeing. It would not surprise us if we see 4% 10-year yields. But we feel that's a level where you start backing up the truck.
You have made some assumptions about the destination for Fed funds, though, Earl. And it stood out for me after the Chairman Powell's speech of Friday. You said once easing starts, you believe the target is neutral at a minimum. What is neutral to you, I guess, would be my question. What do you think the Fed thinks it is? And are we talking about 200 basis points of cuts over the next, 12 months, 18 months?
Yeah, it's a good question. I would argue that neutral to me doesn't count because I'm not the one doing the eases. So I try to listen to the Fed governor speak. We heard Hawker last week say it's 3%. I would say it's somewhere in and around 3%, which says there's 200 basis points of cuts coming over the next couple of years, all else equal. The market's only discounting 100 right now. That is why we saw the speech as unequivocally dovish. The path and timing to lower rates, that's the uncertain part, but we definitely see a move towards neutral. The interesting thing about this, there's 3 things we're looking at in the market that will add to volatility, impact our positioning. One is, as we've spoken about, the employment rate. We think that's very important. The second one's the election, and that will take on more and more, be more amplified as we get towards November. And then the third one, this is the important one, is those risk-off moments that could come from idiosyncratic actions, the butterfly wings that starts a hurricane. So it's that third one. Neutral's 3%, but the Fed put is squarely on the table now. We saw talk of possible 50 in the market when we had the Japan sell-off. That hasn't gone away. So we like being long, we like seeing rates go to neutral, and now we think we have a free option on the Fed put, which could go way below neutral.
Oh, this was great. Appreciate it, sir. Oh, Davis there of BMO. you've earned a weekend on the beach. We shouldn't have favourites, but he's one of mine. Just brilliant.
100%. And I love the sort of scenario analysis that he has and sort of the range. 4% back up the truck.
Big time. The bond market today yields just a little bit higher, just a touch higher by a basis point or two across the curve. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief. The US economy is holding up well. Jobless claims coming in at 231,000 for the past week, just a tick below estimates. GDP for the second quarter revised higher, partially reflecting an upward revision to consumer spending. Elsewhere, Chinese smartphone giant Huawei posting a sixth straight quarter of growth, the company gaining market share against one of its biggest competitors, Apple. Smartphone shipments jumping 50% in the June quarter, Apple dropping to sixth place in the Chinese market. And finally, shares of Salesforce rising in the pre-market, the company reporting a strong profit outlook. The maker of customer management software reporting second quarter results that beat expectations and offering a strong profit outlook. The stock is up by 4.5%. Your opening bell 40 minutes away. Up next on the programme, the calendar for the rest of this week. We'll catch up with Ed Ludlow following his exclusive conversation with the NVIDIA CEO. The opening bout 37 minutes away. Equities improve, up a third of 1%, doing better on the small caps following better than expected numbers just moments ago on the US economy. Here's your trading diary, the calendar for the rest of this week. Pending home sales coming at 10 a.m. Eastern, plus Gap and Dow report earnings after the closing bell. Tomorrow we'll get core PCE and UMich sentiment to close things out going into the weekend. For us right now, still digesting numbers from NVIDIA. The stock is down 3.2%. Ed Ludlow sat down with the CEO, Jensen Huang, in an exclusive conversation. Ed joins us now for more. Ed, walk us through your big takeaways, because yesterday when you were conducting that conversation, the stock was in a very different place.
Yeah, and I think that Mr. Huang was a little bit frustrated about that. You know, go and see the full interview, but at the beginning he literally just stops and cannot believe the decline, because he felt that during the analyst call they'd explained the situation of next generation product quite clearly. But I think that's the main take, you know, that he tried to hit the market over the head with the idea that they made a commitment to bring a new chip to market every year, and Blackwell, the sort of minute focus of the street, is going fine. It will ramp in the fiscal fourth quarter. Supply is improving. And I think, you know, it's just a few words, but he said next year, as in next fiscal year, will be a great year. And I think that's got a lot of people a little calmer this morning in the markets.
There's also a question about the broadening out in potential buyer base, how dependent they are on a few names, and whether that can change. What did he have to say about that in terms of state actors as well as others?
I tried, Lisa. I really tried. I told you that I would, and I really didn't get more than we already knew. The hyperscalers are 45% of the data center business, and Jensen Huang was at pains to point out they have many different types of customers. There was some sort of thin evidence that their business, what they call sovereign AI, which is basically either selling directly to governments or to entities or regional units backed by government money, I think kind of like CHIPS Act money, is picking up steam, high double-digit billions of revenue in this current fiscal year. I still get the sense that the data center operators are the story still.
Ed Ludlow, fantastic coverage in the last 24 hours. Congratulations, buddy. Ed leading our coverage on the West Coast following that conversation with Jensen Huang, the CEO of NVIDIA. Very different place yesterday afternoon compared to where we are this morning, going into the opening bell.
It's barely down, and if you listen to Dan Ives, it'll be up by the end of the day. To me, the frustration was really interesting, and it's sort of, you know, we delivered everything to you on a silver spoon. We thought we explained to you why we did what we did with Blackwell, that it's coming out, and still you're down. To me, the real question is going to be margins, and I think that that's what a lot of people are picking up on, and that's where the questions will remain.
Stock is down 3%. More from Ed and the team on that exclusive conversation later on this morning, 11 o'clock Eastern time, alongside Caroline Hyde, Bloomberg Technology. If you want to catch the full interview, you can find it on Bloomberg.com and on the Bloomberg terminal. Coming up tomorrow, Jonathan Stubbs of Berenberg, Helene Becker of TD Cowen, Claudia Sam of New Century Advisors, and Dana Telsey of the Telsey Advisory Group. From New York City, thank you for choosing Bloomberg TV. That does it for us. Good luck for the rest of the trading day. This was Bloomberg Surveillance.